Yeah, we back at it again. I'm pushing your friendly neighborhood advisor, just talking some money talk, insurance talk, home talk, feeling talk, emotion talk. Yeah, I don't know about that. But we're here, man. We here. Let me go ahead and get some stuff what's cracking over here. Let me do a little clean the house real quick. All right, now to clean the house, everything good. We here, we back at it. We back at it. All right, so getting into it, y'all. But files first one in here, Wanda's in the building, y'all. Y'all go check out Wanda. All right, so you know, felt as it was like a little challenge to me with Broke Farmer. I don't think it was no challenge. I think Broke Farmer was just talking. Shout out to Broke Farmer. Y'all go check him out over there. You doing Broke Farmer After Dark on Tuesday. I'm sorry, on the Monday night. We going up on the Monday. Every day in the life of OCD chick, trying to hit y'all while y'all coming in. Black money in here. What's going on, everybody? Going on, everybody. So as it stands right now, it was not like Broke was trying to challenge me, but Broke was just saying something. And to me, I took it as a challenge. Like, I want to give a little information informing. See, I wanted to go ahead and set this up for this morning, but I think my mornings are going to be hectic now because in the afternoon, I'm dealing with the kids, back on my coaching and helping and mentoring stuff right now during this season. So, the sports season for me is wrestling. For those that don't know, I wrestled in high school. Pretty good at it too. Got second in state my senior year. Really kind of played around the mother years, more or less took it serious. But overall, man, I really got into wrestling, and so every now and then I go and give back, to the young fellas and ladies because they do have ladies that wrestle sometimes. So I go and give back to the community. Go and give back to the youth. You know, not only am I coaching, I'm also doing a little mentorship with them as well. So sometimes I have to give a little support, help the youth out. You know, so be that as it may, get back in here. We're gonna talk about this money game, but Broke Farmer last night was saying that he wanted to leave a little money for the kids and a little land, bump the legacy. He don't want to die as this martyr for the kids to say, "Oh man, I gotta be like daddy. I gotta be good." Like, he's not worrying about all that. His main thing was worrying about the kids having something, a little money, a little land, to where they can keep adding on or whomever they want to do to build. So, I just simply expressed to him, get a trust, put you some money in there and be like the Kennedys. His notion was that the Kennedys already had money. Touche, 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 to a degree. Because, like I said in my small clip, the Kennedys came into money by one of the family members taking upon themselves to, have some type of wealth and to pass to the family. Now, if you see the clip in the description, it talks about a young boy, seeing somebody having a toy as a kid. He wants that toy, can't get that toy because, pretty much their standard is they don't really have a lot of money. So, hence him to say, I don't want my kids to go through this and struggle, so I'm gonna provide a better way. That's most of the time like in two-parent households. You know, One of the kids say, well, my daddy, I want my mama and my daddy to be together. So when I get big, I'm gonna make sure my kids have their mom and dad in their life. This starts trends like that. And this trend that I'm talking about is, kind of relevant, kind of, you know, pretty much revolving around the money. So when it comes down to it, if I say I want my kids to have some money, and let's get it understood, you know, because I do hear a lot of people talking about starting a business for generational wealth, but most of the time you're actually giving your kids some type of debt because it takes a lot to run a business. And if your child so-called wasn't shooting in the gym with you, they can't uphold that business the way you do. You know, most kids don't want to follow in their parents, either family's footsteps. My dad was a carpenter, so I'm gonna be a carpenter. My dad was a mechanic, so I'm gonna be a mechanic. My mom, she studied something, law, or she was a doctor. So I want to do the same. I want to follow in the footsteps. A lot of times, your kids want their own passion, their own way of doing things. So kind of starting to practice, letting the kids take over the practice, starting a business and trying to let the kids take over the business, sometimes it doesn't work because ultimately kids want to have their own path. So that's why I say looking into it first and foremost, leaving your kids a business is technically speaking not generational wealth. There's money in the business, yes, but if they're not passionate about the business like you to a degree, that business might end up defaulting. You know, one thing into a house, having a house, is a form of generational wealth because all they're doing is making payments. And majority of the time, if you play your cards right, some parents bought their houses in the 70s, some in the 60s. If they didn't refinance as much, their mortgage is quite low. Let me give a little short story real quick. My brother's friend had a condo downtown Atlanta. This guy was paying about, I think it was 2,000 to 2,500 a month for the condo. No, real nice. Had the gym, had the pool there, everything, all the amenities he was paying for up under the HOA and stuff. So added up to about 25. Real pricey, but at the same time, I think it was like a 2-bedroom. It was doing his thing, bachelor. So hey, he was living his bachelor life, doing his thing. Then when it came down to it, you look at the situation where he was sitting up there, doing his thing, no problem. Then comes the point of reference when he sorry y'all, got a little distracted. But it was a point of reference when he sit up there and say, okay, well, grandma passed, grandma ended up leaving me. I'm sorry, my manners. Tamika Davis right here. It's country girl Queen. Sorry about y'all. Mind my manners. I'm up here trying to get my talking in, get my talking in. I normally kind of slow down after I really get into the conversation. Keep looking at the chat, but sorry, my man. Sweet Thumb in the building. What's going on, Sweet Thumb? So let me get back to my story. So basically, his friend grandmother passed, and when the grandmother passed, grandmother had a house paid for, free and clear, on the west side of Atlanta. Now, for those that don't know, certain parts of Atlanta, pretty much like the west side of Atlanta, it technically have a lot of old money, because a lot of the older generational people, they kept their houses long time, certain areas, certain communities, they kept their houses for a long time, never gave up. Kids moved on, they stayed in those houses. either refinance or they actually kept the same payment, paid their houses off in 30 years. Now, grandmother's house was paid off in full. And when she paid that house off in full, you know, upon her passing, she put it in a will to give the house to her grandson. Now, this young 30-some-year-old guy, he don't want this old house. And come to find out, the house was abandoned and the family was just paying the taxes on the house. You know, grandma went into a home and house was pretty much forgotten about. The family paid the tax because grandma had the money. She paid the tax probably because otherwise when grandma passed, they was ready to get rid of the house. But they couldn't touch the house because why? The house was in the grandson's name. Grandson didn't want the house. Grandson said, man, people called him left and right, offering him $200,000 for the house, you know, kind of pushing three, but more or less 200 and some plus for the house. Feeling good with his decision, man, I'm going to sell the house. Now here comes my brother. He talks with him. He said, man, why would you stay somewhere and pay a mortgage when all you have to do is go over here and pay the taxes? You know? And so, lo and behold, guy was like, man, I'm just going to go ahead, stay in my condo. I'm not listening to you. He said, man, let's go over there and check it out. Went and checked it out. Kitchen needed to be updated. There was a big hole in the living room to where like some root or something had got up in there, or I think, no, it was a drip. The roof. There was a leak in the roof, which made a hole in the floor, something to a degree. It had a hole in the living room. You could see dirt, you know, down in there. So that was an issue. Everything needed to be updated. The bathroom needs to be updated. All Dr. Dunbar was going on. And when it came down to it, it was crazy because, you know, running to my little story real quick, Dr. Dunbar. Not quick, but long, quick, short, you know. So, prime example, my brother told him, why would you keep paying on something you're never going to own at the condo when you could just have your grandmother's house renovated and just pay the taxes every year? The house was paid off. All you have to do is just pay the taxes. So, took my brother's advice, end up going ahead, getting out of that condo, and went on ahead and moved into the house. Now, $2,500 month one, $2,500 month two. Okay, $2,500 month three. This guy was literally saving money by not paying that $2,500 a month for his mortgage, for his rent, and for the HOA. So he was able to take the first 2 months of not paying and just paying the utilities and stuff and just start working on the house. He fixed the roof, patched it, didn't replace it. All it needed was a patch. Then he turned around and, you know, fixed the hole in the floor, came back around, updated the kitchen, updated the bathroom. Less than a year, this guy renovated the whole house just by saving that money. And this was another thing. This guy was a guy that take trips, have fun. He was a bachelor, single. So he would take all that money that he was investing in all his trips and put it into that house. Like, man, you wouldn't believe it. Like, all that money going into that house. And lo and behold, house was perfect. Housewarming, showing everybody grandma's house, what he did to it. The family appreciated. The family was, you know, grateful about it. They didn't see that house like that in years. But at the same time, the guy he don't owe anything. Then come to find out, got an appraisal for that house. Don't you know the appraisal for that house was around $500,000? So ultimately, if he would have sold that house for $200,000, he would have lost out on that $500,000 home. Being fixed now, that's the thing. It had to be renovated and fixed. to standard of someone coming in and living there. The house is praised over 500,000 compared to a 200,000 somebody was trying to offer him on that home. That's what you're looking at when you're talking about generational wealth. Shout out to everybody. You know what I always say? Drop your links. Everything's cool. Now getting back into, generational wealth. So, broke farmer, we was having our conversation, little short snippet I took from that, and basically explained to him, hey, you want to have generational wealth? Put your money in a trust. I talk this life insurance stuff. Alonzo's trying to, pull me over, make me become an advisor. I kind of laugh. I don't want to tell y'all the reigning joke that I always talk between me and my wife, but I'm pretty good at it. All right. So the thing of it is, I explained to him so simple. Life insurance. A lot of people look at life insurance as death insurance, in which they do have death insurance, to where if you were to die, that life insurance will pay for your funeral, will pay for your burial, repast, all within that life insurance. But the thing is, you have to die. You have to die upon that burial insurance to get the money. If you're living, you're not getting anything. You're only putting money in to where if something happens to you, you're going to be taken care of. Another thing, when you have different policies, you have to understand the policies you have, and also with the trust. Knowing your trust. I'm kind of lacking in the trust. We building over here. Hey y'all, that's the fam. We building over here. We building over here. That's the family right there. That is the family. So when it come down to it, y'all gotta have some understanding. The life insurance is for you while you're alive. Like I say, people focus on life insurance, and hey, no, I did the same thing. I was the one who thought with the life insurance that I don't want to put life insurance on people. I just want to have life insurance for myself just in case something happens, because that was always told to me. Having life insurance is making yourself not to be a burden for somebody when they die, to have to bury you, take money out from the family, do the fish fry, aka the GoFundMe right now. But the thing of it is this. We are sitting here, Frugal Mama's in the building, hey, working it out, Frugal Mama. So the thing of it is, when it comes down to it, that life insurance is helping you. I mean, getting a trust only kind of builds that generational wealth status that you want. That's even a bigger platform. But life insurance starting right there, that's generational wealth right there. See, like I said, there's burial insurance and there's life insurance. The life insurance is for you when you're alive. That's going to be something that you're going to be able to pass down to yourself in your pocket. You can borrow money off a whole life and a universal life insurance. Now, note that with a term life, that term life is set to only a term, 10-year, 20-year, 30-year term. Now, you live over those standards of those years, you're not getting the big payout. You can also take that term before it goes out and convert it into a whole life. Now, you want to typically try to look at doing that within the first couple of years. Sometimes people, you will get the cash that they put into it and then transfer it over into a whole life. And I can't think of the guy's name, Dave Ramsey. And I think her name is Susan something. But both of them promote term to perm. And term to perm is always the thing that people kind of emphasize on. Get a term policy. Have it for a couple of years. It's cheap. Then convert it to a whole life and you're protected. But under what guidelines is that term life and that permanent going to help you? Why not start off with a permanent? Well, let's say you don't have the money. Cool. Why not get a lower plan? You can always change up, you can always add on. In my 20s, let's say I didn't have a lot of money, which I did, but let's say I didn't have a lot of money. I can always get a term, or I can always get a policy that grows with you. Pretty much, they have these small policies. People don't, really, they advertise so much about paying $15 a month. $15 a month. If you cut out sodas for a week or two, most people can pay $15 in that 1 month, just off that week of cutting off sodas. Not going out to eat probably once or twice. Depends on how cheap you eat or expensive you eat. Between once or twice not going out to eat within a week or a day, you can pay for a life insurance policy. Let's understand that. Life insurance is not really that expensive. A lot of people tend to think it because they never had the opportunity to go and research their options. Is life insurance affordable for me? Now, getting into the whole life, getting your policy, actually getting a term or a universal life. I'm going to say the best for last with the universal, but permanent life insurance is great. You get this permanent life insurance, you take the permanent life insurance, get your family involved. You can get some for your family, get some for yourself. Most people typically get the life insurance for just them. The husband and the wife will get life insurance, leave it to their kids. Or most of the time, husband and wife get life insurance and leave it to each other. Now, that's kind of a headache if you really know what you're doing and doing the math. What if both of you died at the same time? Prime example, story time. I had a family member that I knew. Their what was it? The mother died. Panama in the building. How you doing? How you doing? How you doing? I ain't been over there in a minute. I know. I'm sorry. I ain't been in a minute. Hey, Frugal Mama always keep your name alive. She always talking about you over there in the chat. I said I got to get back over there. I think I be having so many people jumping on lives. I catch it and I be like, I'm gonna go back later and don't do it. But I got you. All right. One of our special guests is coming up. If I can tap the screen. All right. What's going on, Lonzo? Let me finish this up real quick.
No problem.
All right. So basically, I think it was the mother died first. No, it was the father. The father died first, and within a week, the mother died, and it was through 19. And so the situation was this: both of them had each policy. So the son had in his pocket, paid for, and battle with really so much battle, but work and have his documentation in order, to kind of get the money from his mother. He was an only child, so it made it easy. Now, considering you have siblings, you have greedy siblings that want to go in there and get that money, that's gonna be a headache. That's a nightmare. Family members, that's gonna be a nightmare. But what's going on, Alonzo?
What's up, Sheed? How you doing?
All right.
I'm still at my location, but I realized that it had been a few minutes, so I wanted to hop on real quick. I'll hop off and then hop back on when I'm on the road. But
That's cool.
one thing that literally, as I hopped on and heard you talking about the horror story of like a husband and wife who get a policy on each other, and what happens if they both die at the same time? And that's a wonderful, wonderful question that you asked, because that's a serious thing and that can actually happen. However, the beauty of life insurance is if you're working with an agent who cares about you as their client, they will actually give you the idea of doing a contingent beneficiary. Now, most of the time when you're starting the application, just for the fact that you as the client probably don't want to sit through the long application process. So we speed it along. Okay, for now, just put one beneficiary, but you can always change it. So you as the consumer want to do things like once every year or once every 2 years, or if things change, a child gets older, you get remarried, call your agent and update them on those things. Or nowadays, a lot of insurance companies will allow you, if you don't have it, call your agent, say, hey, can you send me the link so I can go create my own online profile? And on your online profile, you can actually update your beneficiaries on your own or change your beneficiaries on your own. So you always want to have your primary beneficiary. So let's say you and I both get insurance policies on each other, right? And I make you the beneficiary and you make me the beneficiary. So that would mean that we are what's called primary beneficiaries, right? But now we're both going to think, well, what if we're both in the car together and the car blows up and we both die? Who gets the money then? So then I would make my wife a contingent beneficiary and you would make your wife a contingent beneficiary. So what does that mean? That means if one or both of us die at the same time, or if I die and you're incapacitated, or you die and I'm incapacitated, then we can't receive the money. So our wives would be the second person in line to receive that money. That's called the contingent beneficiary. So most of the time, you as the consumer are, and I do this all the time with clients, because most of the time as a client, you don't want to sit through the whole application process. So to make it faster, I say, listen, for now, just make one beneficiary, because you probably haven't even thought of it. Secondly, you always want to have a will. So if your insurance agent doesn't at least tell you, hey, you should probably try to get a will, or try to introduce you to an attorney or a way that you can get a will, like a lot of agents now are partnering up with this thing called Legal Shield. So I think it's like $50 a month so you can get free access to a lawyer. You get the lawyer, get the will, and then cancel it. Who cares, right? But now you've got your insurance and you got the will. Now, the thing is, you'll probably want to keep that Legal Shield too, because just like every 2 years, you want to update your beneficiaries. Every 2 years, you want to update things like your will. Why? Because every 2 years, things like tax code change and inflation, right? 2 years ago, a gallon of milk ain't cost what it do today. I'll pause there.
Yeah. And you talked about something that was, really spot on. And the funny thing about that was I was sitting there talking to someone and they were saying how I don't know if they seen a video about it or something, but there was a guy who ended up, divorcing his wife, cheating scandal, whatever they did, and he went and remarried less than 6 months. Now, 2 years later, this guy ended up
They got you. You Borgin. Let's see. All respect with this insurance as the consumer. What exactly are we consuming? That's actually a great question, Sweet Thumb. So it really depends on what type of insurance you buy. That's a lot longer of a conversation. Um, but again, it really depends on what type of insurance you buy. So what you're consuming depends on you, the consumer, right? Most people just think life insurance is a check when I die. But what's the main word in life insurance? Life. So you're supposed to use it for things like life. Like, for example, let's take the Black community, right? What's one big thing that we do in the Black community? Oh, cousin Brian, he's got money. I'm going to make him my son's godfather so that when Christmas comes around, he gets good presents. But we know that as a godfather, as a godparent, what you are telling that person is, hey, if I die or become disabled and incapacitated like Terry Schiavo, I expect you to take care of my child. So that would be the purpose of, say, consuming a term insurance policy, right? You get a 20-year term insurance, and since I'm your baby's godfather, you would make me the beneficiary, unless you want me to treat your child like a redheaded stepchild. Because if you ain't give me no money to take care of your baby kid, when I get the responsibility of taking care of him, I'm abusing the fuck out of him. Dead ass serious. But see, we think of life insurance as bullshit instead of reality, right? So instead of thinking of Uncle Brian as the nigga who's gonna give your kid presents, make sure you have the presence of mind to buy a term policy. So maybe you don't buy an extra cup of Starbucks. Maybe instead of buying the fancy shirt from Macy's, you buy a Walmart shirt, right? But then that money goes into something to make sure that your kids ain't got to ever buy a Walmart shirt. Now that will be with a term policy, right? And that's just leaving it to me, the godfather. Let's say you want to accumulate a tax-free wealth. Have you heard of something called COLI, corporate owned life insurance? Please go to Google and type in COLI, COLI. It's called corporate owned life insurance. So, you know, companies like Walmart, when you say, hey, I got life insurance from my job. Well, there's a Michael Moore documentary. You know, Michael Moore, the guy who made Bowling for Columbine, if you're around my age, right? There's a Michael Moore documentary, I think it's called Capitalism, a Love Story, where in 2009 he exposed companies like Procter and Gamble, Nestle, Walmart, just to name a few, that took out policies on their people. One company, Amagi Bank, took a $5 million policy on one of their managers. When he died, none of his family got anything, but the bank got $5 million. So unfortunately, it really depends on what you want your policy to do. Prime example, I have a client who purchased the policy so that he could use it as leverage. Why? Because life insurance adds to your net worth. So now, because he's got a life insurance policy, his net worth is now, let's subtract everything else he owns, because I know he owns a house that's at least $1 million in Queens, New York, right? Let's subtract that. Let's subtract his annual income. But he's worth $2.4 million simply because he has a life insurance policy. He intends on holding that policy to use it to purchase real estate. Now, I can tell you how to use that trick, because you might want to buy real estate. So why wouldn't you add to your net worth? And then go to the bank and say, hey, I'm worth X amount of $1 million. Give me a loan based on that. Not based on the fact that I go to work every day and I work 3 jobs and trade my time for money. See, I don't punch a clock. And you can make sure that while you punch a clock, if you're enjoying what you're doing, because I wouldn't mind punching a clock, to be honest. Why wouldn't I mind punching a clock? Because it's structure and it gives you something to do throughout your day. See, like I said, I'm unorthodox. I'm not going to brag to you like the mother bullshit people, Wall Street Trapper. I made $30,000 in one fucking transaction. I've also made $0 in a transaction. Did all the work, made the sale, closed, signed the paperwork. Client got declined. I made $0 from that. I'll show you my wins and my losses, because I'm really about what the fuck I talk about. At any rate, listen, I got to get on the road, brother. I'm sorry for gabbing. You know, when you get me going, I get going. I'm passionate about this shit, right? I ain't get shot 5 times for no reason. So, I'll pause there.
Yep. I mean, mainly, like I say, getting into it, you have your situations, and a lot of people, they just don't capitalize because of the knowledge. A lot of people, they don't, capitalize on stuff because of the knowledge they don't know. A lot of times, hey, if I don't know about life insurance, hey, I don't know about my options. How can I move to the next step in life? How can I get my kids involved in this? I don't know nothing about it. That's the thing why I started having a conversation, for us to, have about this. And a lot of times people just, like I said, just don't know. And, Alonzo, you sparked something up too. Like I was saying about the guy who, sit up there was having a conversation and was saying how he didn't change that life insurance policy over, and he, it pained him. You know, now his I think it was his ex-wife. She ran off with the money. The family had to sit there and bury him because it was necessary paperwork that needed to be done and it wasn't done. A lot of times you sitting here thinking that people are going to do the right thing, and technically putting her in a situation, she was crushed. So, she was at the mercy of, hey, I'm gonna do whatever I want to do, because he cheated on me. He left me. And sometimes you get those type of decisions, but overall, like you're saying, Alonzo, make sure you're keeping up with that paperwork. That does a lot. A lot of people, they play around. They don't really take their paperwork serious. They don't have the beneficiaries lined up because, like you said, a lot of people don't think about this. When it comes down to your kids later on in life, they're gonna think about it because why? They're gonna be affected by it. Same thing with a lot of times with your wife. If you were married previously and don't have all your paperwork in line, they're gonna be affected by it. You know, and having situations to where you sharp on everything that you know about, and if you don't know, you ask questions. That's the biggest thing, that every time a kid is in school, teaching and knowing and asking questions. A lot of times people lose out from a lack of knowledge. Like you were just talking about the Coley Insurance. They have companies that sit there and make millions off their employees. Prime example, somebody in management. If you go into the management field and you sit up here and have life insurance from your company, they might give you $100,000 life insurance policy on you. So if anything ever happens to you, the family's gonna get it, but you're paying for that policy. Now, the company, they might end up putting $2 to $5 million on you due to, they're looking at their loss if you were to pass and something goes wrong with you. So they're taking a big risk by putting you in this position and being a manager. You're stressed out every day. You're dealing with customers. You're dealing with clients. You're dealing with, disgruntled employees. All that takes the cake, you know. So they get paid upon your death because they're taking a big loss because of the manager that they have that does an excellent job. He's good at what he do, but in one instant he passes. His family gets $100,000, but they get $2 to $5 million. You know, and just like you were saying too, weighing your options, having that knowledge when you get your life insurance to make a will, preferably a trust, to put all your money in a trust to pass down to the next generation. So you won't have your son or your daughter or your wife burn all the money up and now the grandson can't have any. You know, hey, a lot of times people are not taught this, so they don't know to extend to the next generation. You know, prime example, I think I'm about to ready to chop up a little bit because it dropped right here early when I was passing through here.
No
I'm just
problem. I got you.
okay. It probably was like a minute.
That's all right. I can vibe with you. So, definitely there are a multitude of situations. I can't really read the chat right now, but there are a multitude of situations for life insurance. So there's actually, and again, the reason I curse and stuff, I call it sentence enhancements, is because I'm passionate about it. Like I said, I started this because I got shot 5 times. So I nearly lost my life. So for me, this is not something that's like, a lot of people are who sell this stuff don't take it seriously, and that ticks me off too, because there's a lot of people who actually sell it and they don't understand how it works, and then they mislead you, the consumer, for you to not be able to know what you're consuming, right? So for example, like the okay, So whole life insurance, there's a multitude of whole life insurance policies, right? Just like there's a multitude of term life insurance policies, right? So you have annual renewable term, which means that it's basically a 1-year term and every year the price goes up. Then you have 10-year term. You have simplified issue term. You have 20-year, 15-year, 30-year, right? So different term lengths. Then you have things like return of premium term. So what is return of premium term? So return of premium term is you have a term policy that at the end of your term, you can actually get a portion of the premium dollars that you paid into the policy back from the insurance company. Let me get over here. Oh, 1 second, Sean, in traffic.
Tell them still
But
what's going on.
yeah,
Yeah,
go
I'm
ahead.
back. Yeah, I mean, but overall, a lot of people they don't have the concept down, as far as with getting term, getting whole life, because they looking like you said earlier, and I, agree too. Lashes in the building. When it comes down to it, a lot of us we sit here and just think, as long as I get something, life insurance, cool. If I get term, whether I get permanent, and I was trying to say the best for last with the, universal life insurance, you know, and I love that universal life insurance because universal life insurance paid you at a fast pace, in my opinion, and a lot of times without the risk of investing in stocks. You're investing in the stocks without the risk. And that's one thing I love. And then also, your money multiplies faster. And instead of me, it's like loaning the money to the bank, you know. And a lot of times we loan our savings, we loan our checking, we don't get anything but 0.01 to 0.07 on our money,
Yeah.
you know. But if we sit here and take advantage of the life insurance and say, okay, well, I want to get this universal life insurance. I want this universal life insurance. I'm gonna go with the S&P 500, and if anything, if the life insurance, I mean, if the stock market takes a dip, I don't lose. But if the stock market takes gains, I'm winning. And get your percentage each month off of that. See, a lot of times we don't know about this stuff. Like I said, my first introductory to uh universal life insurance, when I took a generational wealth class and they talked about generational wealth through life insurance and they talked about a stock. I went and got this free class and it helped me have more knowledge. That's my biggest thing is trying to seek the knowledge to make my life a little bit better and also do it for my kids. Just like Broke Farmer was saying, how he want to leave his kids some money and want to leave his kids some land. That's why I told him, you get the land and you get the everything, the money in a trust. If you
Yeah.
if you put it in a trust, he won't never have to worry about his kids selling the land off just because they don't want to farm or they don't want nobody else to be on that land. He don't have to worry about the next generation burning through the money because he can put stipulations when it gets down to a certain amount and you don't have more coming in, he can withhold funds. So you sitting here, you got about $200,000 in here. You can't touch it until somebody else get another life insurance policy that guarantees that this money will be replenished back into the life insurance. So there's
Well,
ways
so
of structuring. Go ahead.
part of that is the family trust. So the family trust would be, all right, it's a husband and a wife, and the husband and the wife have life insurance, but it doesn't matter if they die together because the beneficiary is the trust. So if they die together or they die separately, the trust fund gets the life insurance proceeds. Now, the policies that you got on the kids and every policy that they get will go in the family trust, right? So when they die, it goes in the family trust and their kids and their kids and their kids. This is how people like the Kennedys and the Kardashians do it. Does that make sense?
Yep.
Okay. So again, when we're looking at even things like whole life, yes. So that may be a reason for whole life. What I want to do is I want to break down kind of a little bit of each one of them. Um, just because I think people don't get the difference or the education or knowledge of what they're getting, right? So most of the time you ask an agent, hey, how much is $100,000 policy? And they just come and they ask you a couple questions. Okay, how old are you? Do you smoke? You on any medicine? Da, 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 da. And then they say, okay, for 100,000, it's, 75 bucks, right? And then you're like, oh, that's expensive, or oh, that's not. But one thing you have to realize is that you have to stop buying life insurance based upon price, because you don't buy a car based on price. You buy a car based on its features, right? Nobody goes to the store and says, I've only got $11,000. I'm going to buy a car for $11,000 no matter what it is. No, you say, I need a car that does A, B, C, X, Y, Z. I live in an area where there's a lot of snow. So I need a car that, can handle the snow, right? Or things of that nature. Um, So, for example, again, a term policy would take care of a specific need. With a whole life policy, there's a multitude of whole life policies. So, you have a traditional whole life policy that you can get when you're young and healthy, right? So, that might be, for a $25,000 policy, it's $100 a month. And you're like, wow, well, that's expensive. But what do you get with it? Well, you get a certain amount of features and benefits. So, for all intents and purposes, it is a forced savings account, because the money you put into a whole life insurance policy has something called cash value, which accumulates on your policy, and it accumulates with compound interest. So it grows, the interest grows on top of the prior balance, unlike simple interest. Okay. Um, Give me 1 second. My GPS is talking. All right. So, you know, um, come on, dude. Take the turn. Thank you. All right. So, like I was saying, the type of insurance that you're looking to get with a whole life, again, you're getting that coverage, but again, there's a separate savings account and it's like a forced savings. So this forced savings is something that you can actually access and use and or borrow against. Again, another way that you can use or consume the life insurance is to actually use your death benefit as or towards your net worth. Come on, dude. Can you step on the gas? There you go. There you go. You're in the left lane for a reason. It's to go fast, sir. Okay, I'm just gonna go around you. All right, sorry about that, y'all. Um, so the next thing that you were talking about, Sheed, is something called universal life insurance. So universal life insurance is different in the aspect of flexibility, right? So it's also a permanent life insurance policy. Technically, you could call it whole life, but it's better than whole life. I don't like whole life insurance myself. I prefer indexed universal, which I'll talk about next. But universal life is better than whole life because it has what's called flexibility of premium. So what does that mean? That means if I say, hey, for this $100,000 death benefit, it's $100 a month, just for even numbers, right? You can then say, you know what? I got extra money. I'm going to put $300 in this month because I want to add more towards my cash value in the policy. Now, with indexed universal life, it's the same features, but you also get the flexibility of the death benefit. So, with whole life insurance, the reason I don't like whole life insurance is because they keep your money. What do I mean by that? Well, remember when I told you about the cash value? So the cash value is something that accumulates. And let's say you have $100,000 policy and you keep the policy for 20 years and then you get hit by a bus and you have $50,000 of cash value built into your policy. Well, the insurance company takes $50,000 of your money, that cash value, and $50,000 of their money, and gives your family the contractual obligation of $100,000. However, if you have a indexed universal life insurance policy and you choose the flexible death benefit, you can actually have your death benefit increase. So that same scenario where you have a $100,000 policy, you've kept the policy for 20 years, and then you've built $50,000 of cash value on the policy, and then you get hit by a bus. Well, the insurance company is going to give your family the $50,000 of cash that you've accumulated, plus the $100,000 that they were originally contractually obligated to, which is why I prefer indexed universal life insurance over whole life insurance or universal life insurance. I'll pause there.
Yep. And see, that's the thing with me, with that index, you know, you get all your money. And the more you put into the policy, I mean, I know at most insurance they have a cap, you know, it ain't like you can put, you know, $1 million a month into a policy or, you know, 100,000. They have stipulations, but at the same time, you know, those stipulations come upon, you know, the insurance. I mean, of course, everybody likes money, but you know, you structure your policy good. Hey, it benefits you. You know, that's I told my wife, I said the main thing if I was to hit the lottery, the first thing I would do is give me a life insurance policy. And you know, which they took the video down me you talked about where the guy said he went and put 10 million. Waka Flocka has the same video to where he puts $10 million into a policy and he puts it into a universal life insurance or index, and then the next day he tries to come back in and try to borrow some money off of it because he's already paid the premium and stuff out. So all he's doing is getting interest every month while he holds the policy until the end, you know, which would be 20, 30
So
years.
that I actually need to explain as well. So here's why I keep going back to term insurance, because I don't think anybody should pay for life insurance in perpetuity. So what happens is a lot of insurance agents just set up your policy for you to pay $100 a month until the day you die. And while that's great for them, that's not always great for you, right? As the consumer, right? So that's why a lot of people push term insurance because they're not knowledgeable of how insurance actually works. They don't know the product. See, you can get a whole life insurance policy that you treat like a term life insurance policy. So what do I mean? Well, I only want to pay for this insurance for 20 years. So after 20 years, I want to stop paying for this life insurance, but I want to still have a policy and I want it to still grow with cash value. So again, you will get an index universal life insurance because it has those flexible options available. If this person don't speed up or get in the
Alonzo,
other,
he works in the field of life insurance. He's an advisor.
yeah, this is what I do for a living. Insurance, retirement, investments. So also investments, a lot of the time, you won't hear me talk about investments because technically you legally can't talk about investments openly online like that, right? Especially if you're licensed. There's regulations against it. There's things called FINRA, SEC, SIPC, right? There's a lot of regulations and regulators behind it. So, but with insurance, it is an alternative to investing. But don't let anyone ever lie to you and tell you that insurance is an investment. And that's actually a good thing. You see, with investments, you have the possibility of losing your principal. You also have the ability to be taxed. You have to pay taxes on the capital gains. So with life insurance, you can actually access it. It grows tax deferred, and you can access it tax free in many situations. Again, you have to have an advisor who knows how to advise you how to do that. And that's why I began charging a fee and, offering those services. But like I said, um, it's a very interesting thing because a lot of people, again, who actually sell insurance don't know that much about it. Like a lot of agents don't know what COLI is. A lot of agents don't know what BOLI is. So I told you guys about COLI, corporate owned life insurance, but I also showed you guys a document which is called BOLI, bank owned life insurance. So a lot of these things are created or used to create a lot of your pension and retirement funds because life insurance has guarantees. So what's better than guaranteed money? Right? Come on, speed up just a little bit, dude. Baby shark. There you go. I'm an impatient driver, as you guys can tell. And I can't get over there. Here we go. All right. So, again, universal life insurance is my favorite, but each life insurance policy is created for a different purpose. So I have some clients who I've advised to not get universal life insurance because for their particular situation, it won't fit. Now, I also have clients like Yushi who do basically a great thing, which is they get all forms of life insurance, right? So they get a little bit of term, a little bit of whole, a little bit of index universal, a little bit of universal, a little bit of everything. There's also something called variable life insurance or variable universal life insurance. Now, variable universal life insurance is almost like an index universal life insurance on steroids, but there's a huge downside to it. What is that downside? The downside is that you're fully participating in the market. So, with an index universal life, you also are participating. You're not participating in the S&P 500, but you're mirroring the S&P 500. So you're mirroring an index. And when you mirror an index, when it performs well, you perform well in your cash value accumulation. But you may be capped at, let's say, 10%. Whereas with a variable universal life, you have full participation. So you would get that whole, let's say, 20% growth, right? Um, Now, the problem is with the variable universal life insurance, if the stock market goes down or if the S&P goes down, all your money goes down, including the money you put into the policy, not just your cash value. So it becomes very dangerous. Now, that's the benefit of an index universal life because you have a ceiling. So again, you might be capped at 10% growth, but you're also floored at 0% bottom. So if the market were to crash, your participation, you wouldn't participate in any losses that the market had. You would only get zero interest gain. So you'd basically be flat. Does that make sense?
Yeah. The biggest thing, with Alonzo, I talk about this. I met Alonzo, online. This is not a relationship that I met Alonzo in person. Quietly, we gonna meet. I've already said
One
I'm
of
gonna
these
try to make
days.
my way. Yeah, I'm gonna make my way up there. Like I told you, my wife, her family, she has family in Bridgeport. Her
Okay.
mom, they used to stay in the Bronx. They moved to Bridgeport before they moved to Georgia. So I'm gonna make my way up there just one day. But the crazy part is, with Alonzo talking to him, I already knew a little bit about life insurance. I'm not gonna say I'm a savant about it, but I did my research. Like I told you, my great grandmother, she told me about not being a burden by having life insurance when I was, a teenager. Getting out of high school, one of my first policies I had was a Gerber through my mother, and then transferred. I got a little small policy with, I think, Global Life, just getting something, and I didn't know what I was doing, but I knew that they supposed to been the cheapest, and I got something, let that policy lapse, and then end up getting another policy through my job and letting it lapse. And I was like, what am I doing? Upon me having kids, I took it more serious, and I was like, man, I really need to stick to it and grab some policies that will actually benefit me and my family. And that's what made me give more of a stepping stone to growth and looking into life insurances when I, had kids. And that was before my young kids. That was when I just got married to my wife and only had my stepkids. And what made me, climb the ladder even more was when I had my kids. And that's when I
Mm.
was interested in getting policies for them because, like I said, I had a policy when I was a kid. So why not my kids have policies? And then I took it an even further step by saying, well, I had just a regular, I think, term or whatever that aged out when I turned 18 through like one of those Gerber policies. But with me, I say, well, I want to suit a policy just the way I have that can benefit my kids. And that was the next step in me, making that move as well. Like I said, everybody in my household has life insurance. We look to the degree to where if anything was to happen to one of us, it's like passing the buck. And I know you've been getting on me about this, about getting my trust set up, but that's my next step in getting the trust set up. And overall, having it to where I'm looking at getting another policy to where if I do get one, I was telling my wife I want to establish a policy for grandkids, and she was like, "Well, what if the kids never have kids? Then what?" And she was like, "What is your next goal?" And I was like, "Well, I'll cross that bridge when it comes. But if I don't have grandkids, and that policy is just set up mainly for the kids to take advantage of, some more steps in them financially being wealthy."
Yeah, that's definitely a way to do it. You know, I think that's a smart way to do it. And that's a generous way to do it, right? But what you're doing is you're paying it forward because what it is for pennies on the dollar, right? If we could call life insurance what it truly is, it's a wealth contract. Again, this is something that grows tax deferred, and you can actually use it as a tax-free retirement account. I have a video, I'm going to find it, where Ronald Reagan was explaining life insurance is something better than our Social Security. And this was back when Ronald Reagan was running for president, right? He was like, we should privatize Social Security and have everybody buy life insurance. But the big time lobbyists and the stockbrokers make too much money off of people feeling good about thinking that, oh, I'm wealthy like the wealthy people who invest. If I showed you the Bowley report, they put $6 billion into the stock market, but $21 billion in the cash value life insurance. So if they put 3 times as much money in the cash value life insurance than they did the stock market, which do you think is probably better?
Yeah, that's the thing. It's like learning about this life insurance is not glamorous now. Me and my wife were just having a conversation, and I'm just gonna say some people. We were talking about some people because I don't want to throw the family up under the bus or anybody friends. But somebody particularly wanted to retire and don't have enough money to retire. And I
Mm,
was explaining to her, I said, why retire when you don't have enough money? And she was saying, well, this person's been working all her life. She got to the age of retirement that she can retire, so why not? And I was like, why not continue working to provide for yourself? You know,
Right.
provide for yourself because your kids are grown, but of course your kids are always going to come back to you. So enhance, you have to look forward to the future to say, well, if I'm going to need some extra money, I'm going to need that for the kids. I'm going to need that for me as well. Another form, hey, planning. A lot of people are not planning. Like I told my wife, my life insurance is my safety net. You know, she has her 401k. I have my life insurance. I'm investing. I'm go ahead looking at different other options, IRAs and things of that nature. But the whole purpose, you know, my stocks, they come and go. You know, I could be up in the stock today, down tomorrow. I need something that's locked in, that's guaranteed, that can carry me over to where when I go ahead and retire, hey, I got the money in the account. I don't have to worry, you know. And that's what a lot of people are stuck on. They never plan to retire. They just get to the age and say, well, 65, I can retire. I can get my social security, or 68 or whatever, 62. Like a lot of people retiring at 62 because they don't think, for one, either they're going to live to see 65, or they just don't want the government to hold on to that money just in case something happens to them,
Well, a
you
lot of
know?
people are tired, but here's what's crazy: if you were born uh, in by 1967, what's called FRA, full retirement age, where you would get your full Social Security benefit, is age 67. Right? Anytime before that, and you're retiring before full retirement age, so you're not eligible to receive your full Social Security benefit. Now, in 2025, right? Because from FRA, they have something called RMD. What is RMD? That's called required minimum distribution. At that age, which is age 72 currently, can't take exit 2A. Okay. 1 second. I have to take a different exit.
Yeah, can you hear me?
Yeah.
Yeah. You know, a lot of times it's people just don't know. Like I say, setting up for retirement, you looking more at the goal of retiring with Social Security. By the time I
Yeah.
retire, who knows? Social Security might not even be there.
Well,
And a
Social
lot of times
Security is going
people,
to be going by 35. I'm sorry, I couldn't hear you because my GPS was talking.
yeah. I mean, a lot of times we rely on the government to take care of us, and we rely on just, you know, things that are set in place already for us that we have no control over. When I talk about getting life insurance, that's something you got control over because you're putting your money into it. You're weighing your options. You're talking with your advisor, seeing what's your best benefits, your IRA, your 401k. The 401k was started just so people can invest in stocks. I forgot the guy's last name, but it's Todd something. He invented the 401k just so people who are not savvy investors to invest in the stock kind of sort of responsibly, you know, because that's the thing. You can't put up so much money in your 401k, but you can put to a degree a certain amount, three times or four times the much as your 401k. You can put it in the life insurance. See, a
Yeah.
lot of
So
times we don't know that.
actually, there's pretty much no limit to what you can put in the life insurance policy. Um, with some parameters, obviously, you have to have a net worth and some assets behind you, and or an income that supports having that much insurance. But you could put hundreds of thousands of dollars into a life. Give me 1 second, my phone's ringing. You could put hundreds of thousands of dollars into a life insurance policy, um, and it will um, give you returns, right? But the thing is, with a IRA, the most you could put is 6,000, 7,000 if you're over 50. With a 401k, the most you can put in there is $22,500. Now, that's not a lot of money, especially if you make 100, $200,000 a year, right? $22,500 is minuscule if you're pulling in, like I said, $100,000 a year, and then minus that 22,000. Okay, so you're you're putting in what, 80,000 a year, same difference, right? Actually, let me get some gas. Give me 1 second, Charles. I gotta get me some gas.
Yeah.
Well,
I,
not 1 second. I'm gonna just pull the car over.
yeah, I'm holler at Sweet Thumb for a minute. Basically, when it comes down to it, yeah, the thing is we rely on the government to kind of do certain things to help us out. Social Security being one of them. I mean, you put money in Social Security, you're expecting to get money out. Every generation prior to pays for that next generation, you know. But what goes the line to where a lot of entrepreneurs are not putting in, a lot of people who are, going off the grid and doing jobs. That's why I don't want to go into the whole money talk to where everything's going digital and, they're trying to trace the money because the money's getting lost in transactions and stuff. I mean that conversations go way over everybody's head in talks. I mean, even to the point where you have a government job, you might be protected, under certain stipulations within the government. You have a pension, or some people that have those pensions, yeah. But overall, when it comes down to it, life insurance, you structure your life insurance just like structuring a social security. You can structure your social security to where after like a pension, after so long when you retire, they pay you each month. Same thing with your life insurance policy. You can structure your life insurance policy upon you retiring. You can get so much money from your life insurance without even investing more into it each month, or you can get a lump sum. It's pending on you. And that's the whole thing about getting the information, structuring policies that benefit you. And a
So
lot of
there's
people, if you
actually a
don't know the
rider,
research,
that's called the Guaranteed Lifetime Income Rider. So basically, if you set up your policy properly, you can actually set it up so, say you pay in, I don't know, $5,000 a year or $6,000 a year, which is $500 a month, and then you change that policy, or you set that policy up to pay you, I don't know, $7,500 a year. After you pay into it for 20 years, it'll pay you $7,500 a year for 20 years, right? So um, they have a multitude of, you know options that are available, that can actually help you, um, that you just have to be taught about. Now, again, this is not your fault as the consumer, because most of the time agents aren't even educated on this stuff. So how can they teach you something they don't even know? With the stuff they even make them. Actually, think of it.
yeah, and that's the biggest thing, that lack of knowledge, it carries over into a lot of people because, hey, if I don't know that I can take my policy and retire with it, I'm just going to assume, like I said once before, my policy is only suited for me to die, and that's it. You know, I'm just waiting to die. My family get this money. The generational wealth that I'm so called trying to push for my family is when I die. My wife get this money, and the kids get this. My wife, she kind of gets upset that I tell people that I'm putting everything into a will or a trust because everybody's gonna get a certain amount of money. One of my friends, his wife, she is just gonna get all the money and she do what she may. You know, if she don't like one of the kids, she can give the kids $10,000 and she can keep all the money. If she only likes two of the kids and the other two she don't like, she can once again give them 10,000, give the kids that she like $100,000, and she keep the rest. Upon all that, with me structuring my policy through a trust or through a will, The kids are going to get a certain amount of money, and I noticed this from talking to people who had payouts from life insurance and things of that nature, or some type of trust that was set up. If they got their money all at one time, 10 times out of 10, majority of them went broke from spending all that money at one time. 10 times out of 10. They wasn't savvy. Their parents didn't set them down, taught them how to structure policies and use their money properly. Like I talked about with my son, I was like, if you hit the lottery, what would you do with your money? My son was like, well, I invest in business, but also I would not own the business. I would invest into a business. That's what me talking to him, seeing where his head is at, and I'm teaching him the knowledge as a young kid. So when he grows up, he already obtained the knowledge, and he can structurally make sound decisions to better suit for his money. Now, you have parents that don't talk to their kids and kids get money. Prime example. Alonzo did a luncheon to where he had a trust lawyer come on, and she talked about how a kid, I think, got about 2.5 or 4 point whatever $5 million, $4.5 million, and the guy burned through that money less than a year and a half. Like ultimately, this guy bought a Ferrari, bought a condo, trips to Dubai, parties every night. And what's the number one thing? If you have money going out and don't have money going in, that money's gonna be depleted. So now, if the family was smart, or the family taught him about using money and having money, he would have been able to, okay, let me structure starting a business. Let me do something with Airbnb. Let me do something to where I can spend money, but also have money coming in. Whether I buy rental properties, whether I invest into a business and get a profit like my son talked about. That's the thing. You literally have to, structure some type of you know, mindset with your kids to where they can take things which you didn't teach them and go to the next level, in which I'm doing now. You know, my policy, the thing about me with life insurance was only to get life insurance for me and don't be a burden to my family. I took it a step further to create generational wealth, not only to be a burden, but to actually give money to the next generation to keep going.
Well, that's exactly the perfect thing. So, again, life insurance is exactly for that, is to leave money for the next generation. But it does also create generational wealth. But don't forget, it also helps you to create wealth for yourself while you're alive. Most people, again, just most agents who sell it aren't educated on that fact. So without even knowing that fact, most consumers just unfortunately aren't going to get taught that fact, right? So you don't even get taught a lot of the concepts or how to use it. So that's why it's things like Waka Flocka coming on are dangerous, etc. Because um, a lot of agents don't know how to do it. So then when you as the consumer come to them hoping that they're setting you up right and they don't. Um, and then you may have a sour taste in your mouth, right? So it's always good to, vet the agent and ask questions, right? Now, the thing is also, most people are going to give you what's called an insurance quote, and that's not what you want. You want to get an illustration. You want to see kind of what it is that you're getting. But hey, listen, my phone is about to die, so I'm going to hop off and watch from the clouds, and then speed home as well. And when I get home, I'ma hop back on.
Yeah, okay, cool.
All
But
right.
basically, that's the thing. Seeing what's your options. Back to what Nino was saying about, the family dying and everybody arguing over the money, and as the person being buried, dad should have left me this. I need this. And, ultimately spending the money so quickly, you know, they don't have that knowledge. All they know is one of our family members died, how much they left us. You know, did they leave us any money? How much they left us? You know, family members not even in the ground. Prime example, I had a friend, I was talking with him. He told me that his mother had passed through a situation, and upon his mother passing, the brother was, staying with the mother, making sure she was okay. Even though she had a caretaker come and, visit, he basically just needed somewhere to stay. But he stayed with her. His thing was, y'all buy me out. I don't want to stay in this house. Buy me out to where y'all can sell the house, or buy me out to where I can get some money and I do whatever, and y'all can keep the house. I don't want no parts of that. And it gets emotional to the point where, everybody starts to get entangled. It's like money grows on trees and things of that nature. Systems and the generation. And what is 60-year-old insurance need? Okay, prime example with this. All right, the payouts. A lot of times, people policies aren't structured right, and I know this by fact because some people. Okay, prime example. My grandmother, her policy lapsed, and I paid for her funeral because her policy lapsed. They took the money and just only gave me back the cash value that she put into the policy. And she only had that policy for 2 years. Another one of her policies left. I didn't know none of this because, tend to a lot of older people, they're shamed or they keep this information to themselves. Now the ones that actually had policies that paid out, another family member had a policy paid out for about, I think, 60,000. Uh, Go example even further. My great grandmother. My great grandmother had a policy that paid out for $50,000. They buried her less than 10,000. That's even with moving her from Georgia, where she passed, and proceeded to move her down to the country where we're from Greenville, and that was less than $10,000 for the casket, everything. Move her, had the repass, all that down in the country town of what was it, 30 minutes outside of Atlanta, where we're from. $50,000, and the family split the money up, amongst the three kids that were left because my uncle passed before my great grandmother, and then she passed. So they had, let's say, 40,000 after the 10,000 for the funeral, everything. 40,000 is split amongst three people. You know, prime example. You have other people. Let's say car crash. A lot of times you will have situations to where family members have the money and don't say anything. Another situation, a friend of mine, his father passed, didn't know the will, didn't know anything. To a degree, they found an account that was, still open, tons of money in there, and they seen a withdrawal kept coming out of that account. They called the insurance company, let them know that he died. You need the death certificate. How many people can get a hold of that death certificate? Yeah, I do. I have. That's where they were from. I didn't want to say it, but LaGrange area. That's where my family is from, LaGrange area. Um, but yeah, you have people that need that death certificate to get that policy. And prime example, my uncle passed. My uncle, he basically told me he was only gonna get a policy about $10,000, enough for him to be buried. He let another policy lapse that he had for about 10 years with I think it was a sum of 50,000. He got older. He wasn't worrying about leaving nobody no money. And it came down to a point where, you know, he said, "Man, I'm just gonna worry about myself." And Alonzo speaks on this. A lot of times, people only buy policies for themselves, just primary to take care of me, and that's it. And exactly what you're talking about now, Sweet Thumb. Like when it comes down to it, if I have a $10,000 policy and I fool around, and it's crazy. We might do have family members. I mean, it's small world. I work with a guy at my job. He has family members from South Carolina.
and that's the side of my great grandma's side, the Park side from South Carolina. But it's a whole nother story. But the crazy part, like I said about that, when it comes down to it, you literally have people that only buy $10,000 worth of life insurance. How much is generational wealth can you get from $10,000 right now? When my great grandmother passed, uh, I think her funeral was less than $5,000. You know, when my uncle passed, I paid $8,000 because he named me as his beneficiary to get his money. Everybody came down, tried to take over the funeral arrangements. My grandmother, she was the one that took care of everybody funeral arrangement. So 9 times out of 10, when it came down to it, everybody always had my grandmother up under their policy to take care of their arrangement because she was deemed, the elder sister and take care of policies. When she passed, I took care of her policy. When my uncle passed, I took care of his policy. And my aunt told me, said, well, it looks like you're going to be the one stepping up to start taking care of policies for people. And, didn't have a problem with that. But the thing of it is, when it comes down to it, people don't buy their policies to structure generational wealth. My uncle only had $50,000. My great grandma only had $50,000. Now, during her time, $50,000 was a lot of money. She still had that plan from years and years ago, probably paying $15 or $20 a month for that policy. My policy is not structured like that. My policies are my three policies that I have are structured to where I have more money. And I'm looking to gain or get more money off these other policies that I'm going to buy and the ones that I already have. I structured these policies to the point where one of them I'm getting the max. If I retire at 78, I get $4.3 million at the current rate of which I'm putting in the money now. If I put in more, that amortization schedule changes. Its schedule changes from me getting 4.3 million to according to how much I put in to according to the market off the index that I have. I stand to get 5 million. I stand to get 10 million according to the amount of money I put into my policy. Now, when that policy pays out, guess what's going to happen? It's not that somebody just going to take the 10 million and run with it because for one, the thing about it is too, when you have these type of policies, how many of your family members know about this? The number one thing, like even with my wife, before she even knew I had these policies, I was talking with my cousin. The number one thing you got to get out of the mindset in which most people do is, hey, I got this much money on my head. Somebody might kill me. Somebody might do this to me. The thing about it is, having my policy structured and have a certain amount of money, you know, prime example, you got to be able to trust the people that you have these on your policy. You got to be able to deal with these people in a quarterly fashion. You know, hey, look at the Menendez brothers. They killed their parents, and hey, I don't know if they thought they was going to get away with it or not, but that's the thing. When it comes down to it, I haven't talked to a lot of my family down south in a minute. I'll talk about that in a little bit. Um, but the thing of it is, a lot of times people don't structure their policies to where they're giving generational wealth. 10 times out of 10, prime example, when 19 happened, just, breaking down the statistics in the black community versus, white, Chinese, everywhere else, structured by structure. And when 19 happened, you know, just not really saying the whole 19 name and everything, but the point of reference is this. Don't you know there was less than I would say about $5 million. I would say about $5 million paid out within the black community when 19 happened. Now, that doesn't say that, there wasn't a 500,000 people that died within our community, but you got to understand. Let's even double it up. Let's say 500,000 people had, you know, $50,000. You know, let's say 500,000. I mean, just even with doubling with the math, 500,000 people, you double that, that's $1 million. You know, so all those people structured within the community only had like $100,000, let's say $10,000 on each other. That's no money. Where you had in other communities, and statistically, you can look it up within other communities outside the black community, when they died, it was $92 million paid out for 19. What's the big difference? And even if we break down the statistics from the white or Caucasian, people want to call it, the Chinese community, the Mexican community, Hispanic, or however you want to say it, the Indian community, um, doing the African community, African American or African, however you know break it down your terms, there was $92 million paid outside of the black community, which it was less than $10 million to be exact. I think it was like 9.9.1. Alonzo can quote me on this because Alonzo, he did the numbers. He did a story on this. The numbers don't lie. People don't buy life insurance right, so that's why they suffer. You can't give generational wealth to the next generation with $10,000. That's the thing. You know, no matter how you look at it, if you're paying a life insurance for 50 years and you only have $50,000, how much are you paying a year on that life insurance? You know, even if you have a life insurance that you done had for 10 years, and let's say you pass and the family gets $30,000, how much is $30,000 when you still owe 180,000 on the house? And they do have policies that way. When you first buy your house, I think it's structured within the first 3 years that you can buy a policy to where if you die, your house get paid off. That's about $100 a month. I looked up that policy. You buy a house, within the first 3 years, you can get a policy to where if you die, the house gets paid off and you leave it to the family. All you need, once again, is a death certificate. A lot of times, let's say somebody's family, you know, they get a policy up under you. They need that death certificate, which I know because I had a family member do that when my uncle passed. She needed a death certificate and she told me it was for tax purposes. I already knew she had a policy out on him. You know, like the old people say, I was born at night, I wasn't born last night. But the thing of it is, why should I deal with her policy? And that's something that she bought to side for herself. And a lot of people do that. You know, shout out to Alonzo for giving me this information. In certain communities, um, I don't want to say for the most part, you know, the algorithm stuff. But the thing is, they literally sit there and buy 7 different policies on the oldest person in the family. I was on Erica Williams, the Classic Climb. Shout out to her channel. She sit up there and talked about how that there was this family that had an old person in their family, and grandma was old. Grandma was old. They was paying. They had 10 grandkids, got together and paid $1,200 a month for her life insurance policy. And within 3 years, grandma died. It was $1 million in that policy. Imagine you paying 10 kids, paying $1,200 a year. So what that adds up to about what 100 and some change each month. You know, 100 and some change each month. What is about 120, 105 or whatever, $105 or whatever each month for whatever. I'm kind of short on the math right now. 12 and 10. Let's see, that's 112. 200 going to 12. That'll be 18. And what about I just math right quick is kind of off. But the point of reference is they were paying less than 200, less than 150 a month. And literally within 3 years, grandmother passed. It's a sad situation. All these were the grandkids that paid this policy. Every grandkid that paid into it, the 10 grandkids, got $100,000 off of that. How many people are structuring this like that in their life? Not many. See, that's what I'm talking about, sweet thumb. You'll literally have 10,000. If I die right now, I only got $10,000 life insurance. There's no type of generational wealth in that life insurance if I do that. $10,000 a month is not, yeah, the math is late. uh the crazy part about it is, we talk the talk, but a lot of us don't walk the walk. $100,000 is not nothing. I have one of my policies for $100,000 on my whole life. That's nothing. The other policy I have, the term, I have so much in my term to where if anything, to where if it gets to be a point where that term is not going to do anything for me and I'm going to pass, I can go complete. If I'm not going to pass, I can go from term to perm. I can take my term policy and switch it back over. Yeah, 120. Yeah, yeah. Like I said, I was short with the math. Thank you. But the point of reference is, point blank. Oh, the OG Gardeners in. Yeah, y'all sliding in here real quick. And the thing, like I said, about the generational wealth, a lot of people don't buy policies to create generational wealth. A lot of people buy policies just to be buried. Let's get an understanding. When we were talking about that earlier, a lot of people only buy policies just to get buried. So when it comes down to it, if I get a $20,000 policy, nowadays you could take $20,000 and spend it on a burial real easy. Prime example, like I say, cremation. 2000 cremation before 2000 cremation was around I think $1,000. No, I take it back. It was because we did boom, boom, boom. Cremation was around $700, $800. Around eight, I just say $800. You know, cremation's around $800. Now, going back in the day, Sweet Reed was going on. What's going on? Back in the day, cremation would probably range you about $400 or $500. That's the thing. That's what I'm looking at now is getting a policy to where I get burial insurance and I get it through a mortuary or a funeral home. One funeral home that's real big out here in Atlanta is Willie Watkins. Willie Watkins has about, I think, 3 or 4 locations they know. Wacky, what's going on, man? Long time seeing you in a minute. And to a degree, I can go ahead and pay for my funeral arrangements now, my cremation or my burial. I can pay for my repast. Far as the food, just set aside like the amount that I want to put down for my food. Like due to inflation, if I have a lot of people come, I could put 10,000 down on the side for the food and the repast. It probably could be only 2 people come. I got all this money set aside that can just go to the family. You know. But when it comes down to it, we we have to start with zero the foundation first. What do you want to do? What do you want to provide for your family? Just as Broke was saying how he wants to, kind of get this money set up for his kids and the land, that's the first step. How much money do I need to set aside for each child and my wife? How much money do I need to set aside for my land? Or am I going to go ahead and buy the land now? That's the thing. Shifting, what's going on? Shifting some soil. Now, do I want to go ahead and buy the land now, or do I want to go ahead and do it later? Cross- say the scene where help my family are trying to help. All right, so this is the thing. Alonzo, I'm dealing with Alonzo. I've been getting on Alonzo because Alonzo has some health issues, and I, try to kick him, get him right. But the thing is this. Oh, everybody's coming in pretty quick. Not some, stuff. Alonzo, I get on him about getting his health conditions together because we both need to either die around the same time or I pass before because you're my advisor. You know, you're somebody that my kids can reach out to when they get older and have an understanding of their policy in which they have up under you as well to say, okay, what are my options? I opted to get not a term policy. I opted not to get a whole life policy, but a universal, index policy as well for my kids to where it grows with them when they become an adult. That policy is structured like that. What's going on, micro farmers? And that policy is structured like that to where, let's say, prime example, one of my term policy. I got a term policy through this company, and the lady I was talking to, she had a pre-existing illness before she ended up, moving her policy around, changing some things. Her parents got her a policy, and she ended up, restructuring the policy when she had a family later on because it was a whole life. Things happen, stuff like that. She had a pre-existing, thing to where she couldn't keep just buy another policy, but she already had a policy in play, so she structured around. Same thing I deal with, the issue with my boys. I wanted my kids to have something to where, let's say, if something happens to them, they're 12 now, and I have twins. So if anything happens to them between now and adulthood, they're covered under a policy that's going to grant them. They can always go and get another policy and make more money. They can always modify the policy, put more money into the policy. Structure is up to them. But the whole thing is, I didn't want to get them a term policy. I wanted to get them something that they can grow with their family because that's the thing. If anything, this policy can carry over to their kids and their wife. If it doesn't carry over, they don't get married, this policy can carry over to what? Another family member, or when everything's set in play, they can have that policy put into the trust to where things still move. And see, that's the whole thing about that generational life, that generational wealth that I want to speak on because the biggest thing is if you don't know, you're not going to do it. If you don't have no idea how it works, you don't have no idea how things are structured, you're not going to get into the know-how or understanding. You're not buying life insurance for 100,000 because who are you going to leave the money to? Prime example, I told one of my friends. One of my friends, he wants to get his a policy, and I told him, he's like, well, I don't really have kids, so who am I going to leave the policy to? Yeah, I'm talking about whole life, but this is the thing that I'm talking about. With my boys, they have universal index, and with that policy, it grows with them. It goes off the stock market, the S&P 500. The index goes off the S&P 500 to where as long as the stock is doing good, you're getting that 5 to 7, some of them is 10 to 13% now rate of return each month off that policy. It's like investing in the stock market. Now, this is the catch. If anything was to happen to where, let's say, the market is not doing good, the market is doing horrible, you don't lose. That's the great thing with this investment. You don't lose money in this investment. You only gain profit. It's protected to where you only gain profit. So, you know, just like everything that people invest in, knowing your risk and your reward, this is a win for me. That's why I got my kids the same policy. It's a win for them, and that's why I say do your homework. When I talked to Alonzo, it was already, understanding that he has some knowledge. Okay, I give you that. You know a little bit about life insurance. You know a little bit about selling. You know a little bit about, pushing the envelope. Okay, now, how are things structured? When I start doing my research, because I'm going to fact check. If you say something, I'm going to look at some other advisors. I'm going to look at some other information. Alonzo had everything down to play. And, I don't want to toot my own horn, toot. But when Alonzo, we made the first initial talk outside of dealing with YouTube, because that's where I met him at. I gave him my number. We had the conversation. I said, okay, I want to look at getting a policy. Only reason I reached out to him, I've already vetted him and I had my thoughts on what I want to do, just have an understanding what he can help me with. And then my next step was go ahead and reach out to him to start, my process on the policy. So at the end, he was, we had our conversation, what policies we want to pick, what policies would be better and suited for me. Bronze, what's going on? And in the end, he was like, well, give me a call when you're ready to set up everything. And I laughed because I said I was ready now. And that was my whole thing. I'm not going to reach out to you and say, well, give me a couple of days. I got to get me some money together. I already had my money together. I already knew I want to go ahead and start this policy now. I already knew account I was going to set up. I already knew the money I was going to, come out with. I can always start with this and move up. But the best thing for me is to go ahead and weigh my options. Okay, if I have this new job, am I going to stay here? I'm already structured. I'm already settled. What are my options? What money can I free to deal with this policy? Do I have free money for this policy? Let's get it started. You know, and that was the biggest thing for me. Okay, set that up. Lonzo was like, call me. I said, I'm ready now. I said, I got my bank card out. Do you need my routing number? You know, I have all that right now ready. Alonzo was like, okay, all right, let's go. Read them out to him. This the bank I bank with. I want to have this policy set up like this. Me and my wife. I want to have the brothers up under there to where if anything happens to both of us, each brother they can take out for themselves. I can add their older brother and sister later. And you got to have an understanding to where, hey, those are minors. They're not yet 18. So if anything happens to one or the other or all of us at the same time, who's going to get this policy? You know, and that's when their older brother and sister come in. Let's say we have a family trip. That's the whole point of getting that trust set up to the generational wealth goes on to what? Who and whatever. You know, I talked to my friend several times. I have a real close friend that, he has a lot of his things structured real well financially. And I told him if anything ever happens to me, you got some shoes to fill. And he said likewise. I was like, I'm laughing. I'm like, what do you mean? He said the same thing you talking about. We both agreed that where if anything was to happen to either one of us, our kids are gonna have to go with each other. Like, hey, I don't want them separated. I want them going here. I want them to stay in this area. Um, if we got to get some things to where we move, we got to get some things to where things are in play to set up, and that's the whole thing. A lot of us are not having these talks, like I talked about earlier, Sweet Thumb. With a lot of us, we're only buying $10,000. We're only buying $20,000. $20,000 is not generational wealth. My 100,000 that I got, that's not generational wealth. $100,000, that probably can pay on my house, pay it off to the degree, pay down on it. Then what else? Yes, they have a house. They can, accumulate that wealth over the years with that compounding on the house. Okay, prime example, they want to get some updates to the house and sell it. If you sell the house, you're going at market value. Hey, you're gonna be at a rat race. Let's say you keep on, and let's say, okay, I don't want to sell the house. I want to take 50,000, put it in the house, get it down to where I'm not paying more interest. I'm paying more towards principal. And note, a lot of people don't know that. You take $50,000 and put it just on the house, they're going a percentage to principal, a percentage to interest. You got to tell them, I only want it towards the principal. See, a lot of times, like I say, we don't know this stuff. Just paying one extra payment towards principal will knock 3 years off your house a year. This the things that we got to talk with people that are in the financial industry and know, because right now, hey, it's multiple ways that we can save and do things, but we don't know, you know. Yeah, and when it comes down to it, you know, when it comes down, there's a lot of times with $100,000 can benefit somebody in their life if they know how to use it. $1 million can be a great thing to have if you know how to use it and structure it properly. But the point of it is having $1 million and not being able to know what to do with it or take the next step into what we talk about generational wealth, you're going to burn through that money and there's nothing going to be left for the next generation. You know, that old saying, um, my dad rode a Campbell, my granddad rode a Campbell, my father drove a car, my son flew in a plane, and my grandson rode a camel. When it comes down to that, we have those type of things to where it happens like that. A lot of times we don't structure things properly. We don't have our family things, far as the financial setup, to where when it comes down to it, what in the world? Alonzo, you might have to come on. I got somebody in my house.
All right, no problem. I'm actually on try and come on from my computer.
All right,
Give me 1 second.
cool. Yeah, I mean, but that's the thing. Like, we literally have all this money structure set up for the family. But the point of it is, you got all this money, you don't know what to do with it, you're gonna blow it. You got to teach your kids to be financially savvy to where when I have some money or they have some money and I'm giving it to them, what's the next structure, plan in order for them to, create more money. Like I said about the guy, 4.5 million dollars. Within a year and a half, he was broke. He bought a Ferrari, he bought a condo or a house, balled out, taking trips to Dubai, taking, all these lavish trips. And in the end, what did it do? Nothing. You know, he was putting so much money out, wasn't bringing nothing in. So in the end, you sit there and you have things like that, like Nino says, narratives and dialogue. His aunt got $1 million. What did she do with the $1 million? Did she burn through it? Did she invest in? A lot of times people are not investing. They're thinking, well, for me to invest, I have to take my money and just go put it somewhere else. Like, I'm gonna go put it in a restaurant. You know how many failed restaurants in certain attempts? You know how many situations to where when you try to get so much money, it never works out? Because all the time you have family member, have a little echo. When it comes down to it, a lot of family members and friends, they don't know how to use their money properly. All they know is, hey, what's the young generation call it now? The NOLO, to where you only live once, to where you take your money, you ball out. You know, go to Louis Vuitton, go to Prada, go to Gucci, buy the nicest of things, go get you a nice car, have these nice extravagant trips, stunt for the gram. The people who have all the money driving a Honda versus, all these luxury cars. Prime example, people like Steve Jobs. I don't think I ever seen Steve Jobs in a Gucci sweater or a what's his name? Future. Gucci flip flops. I never seen Steve Jobs in Gucci flip flops. You know, I never seen Mark Zuckerberg, and you might get to a point where they might have a $200 T-shirt on, and it's because of the fabric. But other than that, it's not a big name brand that's reaching out to them. You know, and a lot of times you get people that have all this money, don't know how to take it over to the next generation, but because hey, their self-talk is to stunt, show everybody that they got money. You know how many people, who came without money? Prime example, the basketball player, I think his name was Reggie Bullocks. This guy ended up buying a island for $5 million. Bought an island, broke it up into three sections. I think they said his net worth. I did a video on him before. His net worth was worth about $12 million, but he bought an island for 5. That doesn't include all his investments that I think he is not reporting on his net worth. But the point of it is, hey, guy bought an island for $5 million. He can sit here, have his family there. Hey, want to sell the island in a couple of years, all the modifications that he put on that island, he probably can get about 20, 30 million for that island. You know, and the point is having something as a contingency plan to where you can steady make money. Like I said, having a business structured, say, well, I got a business. That business, how well is that business going to do for you if it's a headache, if it's a nightmare? You have, employees that, don't work properly and do things to structure your business to keep it growing. You know, your business is a steady decline. That's not a generational wealth. That's a headache for the next generation. You know how many kids don't want to be plumbers because the dad was plumber and the dad is sitting on $1 million plumbing business? They will sell that $1 million plumbing business for 100 to 500,000 just because they don't want to deal with that headache. They hated plumbing. Dad had the business. They didn't know nothing about it until they look at the books and say, man, I got to keep this going. But I never had a structure on to understand how well this business paid until I let it go.
Well, actually, Sheet, so you mentioned a few good things. One of the things you mentioned really quick was the business continuation.
You
And
kind of low.
can you hear
Might
me
have to
better
come up
now?
to you, Mike, a little bit more,
You hear me better now?
a little bit.
Hold on. Let me see, because I
Yeah,
got
and,
this
and
plugged
I,
in.
I talk about this a lot, Sweet Thumb. When I'm talking about breaking it down to money, when I'm talking about budget, every time I talk about a budget, you know what you're spending every month to a degree until you actually sit down and say, wow, man, I spent $800 eating out last month, and I also spent 300 at the grocery store. I should be spending 800 at the grocery store and 300, what I'm saying, eating out. That's the thing. A lot of us don't know our budget. Mint. There's an app, Mint. You hook it to your credit card, hook it to your debit account, and it splits all the transactions to where you can see what you're spending your money on. Or you could do it the old-fashioned way of writing it down. But in some cases, most people who have debit cards, they have structures like that within your app to where you can look at your money. But the best thing that I've noticed a lot of times when you talk to people, they don't want you to know money. So banks, they make money off your, ill-informed knowledge. If you don't know how much money you're spending, and in most cases you see this on your statements, and I seen this on a Netflix special. This woman, you know, she accrued about I think it was 3,500 a month. Out of 3,500 a month she get paid, She was spending 3,900. So where was the extra 400 coming from? You know, they was pulling from a little savings here, a little extra money there, and the old people call it robbing Peter to pay Paul. You know, a lot of times we don't have the money talk with our family because why? Nobody wants to structure those conversations. You know, mom is spending money on Gucci shoes and purses, $10,000 on the purse, but yet we have a car with a leak on it. The brakes are bad. Prime example, one of my friends, his his wife's friend, let's say, she had a X5. She paid $5,000 per wheel. You know, was it 5,000 or was it? I think it was, yeah, about $5,000 per wheel. So it's almost like almost, I think, no, was it 10,000? I think it was like close to 10. So 25. Yeah, it was 2,500 per wheel because it was $10,000. She paid 2,500 per wheel for new tires, new brakes, rotors, and the mechanic doing the job, whatever they upcharge or else on anything. In total, she paid about $10,000 for that X5 because she burnt the wheels, she burnt the brakes down all the way down to the pads, and they were scrubbing the rotors. She didn't have enough money. She took that car, traded it in. That's the thing. The cars look glamorous until you deal with the maintenance. That's why I didn't buy my wife no BMW. I told my wife I can buy you a BMW all day. I can buy you a Mercedes all day. But the point of it is you pay the maintenance. I told her, I said, prime example, go in there, look how much it costs for an oil change. Most time people look at Mercedes oil change 250 $250 a year. They say, man, that's a lot for one oil change per year. But you gotta understand, because I think one of my friends, he had a what is it, SL 550. He paid oil change once a year. But the point of it is, if you do the math, 35 to, let's say, $50 of oil change, and you're doing it every three months. Every 3 months, that's 4 quarters within that month. Four times five, that's $200. So you're almost paying the same. It just structured different. Yeah. Hey, Marco knows. But the thing of it is, a lot of times people don't know that, and they look at that 250 right then, but not looking at the upfront if you were to break it down in payments. Same thing. You know, the structure on the tires. A lot of people want those cheap tires. Man, you got to get all season. You got to get, some type of driving performance tires. And you can't be getting those tires off the rack. You got to get some good Firestone, Goodyear. You got to pay a little penny for them. I had one guy I was talking to when I was getting my tires one time at Walmart. He found Walmart had a sale on all season Goodyear tires. He bought all four of them for there. He's like, man, I'm shopping around for these tires. The guy gave me a good deal. I got all four of them here. And that's the thing. A lot of times knowing what it helps. Knowing the structure with a policy, knowing structure with, kind of your budget, it helps down the line. You okay, Lonzo? You over there still?
Yeah, I'm here. I was just letting you go for a second. I was handling a couple things.
Yeah.
So a couple things I wanted to holler at was something that somebody said in the chat and something that was related to what you were saying. One of the things is a lot of the times agents don't know, and that's one of the problems. I saw somebody had put in there in the chat earlier. They spoke to an agent and they didn't quite know. Like they weren't knowledgeable. A lot of agents aren't knowledgeable, um and so it's very difficult for you to even get the right concepts or to know who to look at, um which is why a lot of the time most people just say, well, let me think about it, because generally that means that you don't have enough information to make an educated decision. But that person that you're sitting in front of is supposed to have enough knowledge. 9 times out of 10 they don't, because insurance is a hard business, and 90% of the people who get into it get out of it in the first year or two. But if you don't mind, what I wanted to do real quick, she would share my screen and show a couple of different things real fast in terms of what you're buying and what you're getting. If I don't know if you see
Yeah,
it in
go
the
ahead.
back. Yep, you got it in the back.
Oh no, I'm on my phone. I can't share.
Oh, you
Oh,
can't
hold
see
on.
the other screen share. Okay. And let me she says no insurance when mama or day dies, no GoFundMe back then. Yeah, that's true. That's
Yeah, I'm a,
very true.
I can share a screen. Give me like 2 minutes. I was in the car. I'm finna come in now.
Okay, no problem. So I mean, I can speak about it until then. What I want to show you guys real quick is, again, there's slight differences in between what you're purchasing. So for math's sake, I'm just gonna show a 41-year-old non-smoking male who's healthy, but I'm gonna show $100,000 death benefit and the difference between buying life insurance or death insurance. So in fact, give me a second and I'll create all three of those, and then I'll do it like that. Firstly, uh, while she's coming back, I'm gonna create the illustrations. So I'm gonna show you the difference between a term life and a whole life and a universal life. And so we're gonna input the face amount. We're gonna put monthly here. We're gonna do term 100,000. We'll do 10, 20, 30 years. Boom, monthly. We'll preview that. And he said no insurance when uh mama or day dies. Unfortunately, so that's the thing actually. And she was talking about the numbers. Those may have been for a particular city, but it was actually in the billions. So during 19, I believe it was 60 billion that got paid out, and only 1 billion went to our community. But overall, life insurance is purchased the wrong way by people, because you're miseducated, right? Most of the agents don't know what they're doing. So, if, for example, a lot of people talk about this thing called generational wealth. So, I'm going to take you guys in live time and show you that what generational wealth really is. Because I'm going to go to Google and I'm going to type in how long is a generation, and it'll tell you between 20 and 30 years. But I'm going to share my screen and show you all that. Let me do a whole life here. So we got a whole life, 100,000 face amount monthly, and then we got a 10 pay whole life, 100,000 face monthly preview, and then I'm gonna do an IUL. 100,000 face option A preview, 100,000 face option B preview. All right. So he says, my tires look real good, but I have a black eye. I hope that's from driving and bumping your head. I actually need to get some new tires myself. So I drive a Benz, but in my Benz actually I need to get a bunch of work done on it. But I actually don't drive it enough to even care about that, to be honest. I rarely drive my car. But the tires that I am gonna, so I'm trying to decide whether I want the OEM tires, which are Continentals. Those are about 3 grand, and then, or if I want the Pirellis. The Pirellis don't last as long, but they look cooler and they're kind of a flashier name brand. Like Pirellis would normally be on a Porsche, but you'll also see Pirellis on the higher end Mercedes. I have an E class, so that's a mid level Mercedes, right? But in terms of that, um, it those tires are not cheap. I also want to change my brakes. I'll probably get Brembo brakes, but it's an investment. Um, if you take care of your vehicle, and it's a luxury vehicle, right? Because they hold their value to a certain point.
I'm back.
All
Go
right.
ahead and share your screen.
Okay.
Yeah, I had a pair of Pirellis on my pickup truck. Believe it or not, I actually got them on a sweet deal. The guy that gave me the Pirellis, actually I could have shared it.
Oh, that's all good. First thing I'm gonna do is go to Google and see how long, or no, let's say how many years is in a generation. So typically, it's a 15 to 20 year span, right? So that's how many years is in a generation. This is generally because we always talk about generational wealth. So if we say how many years is in a generation, let's say what is the average income in the U.S.? $31,000. Okay, let's say in 2023. So between $50 and $90,000. So this says the median household, so that's husband and wife, pull in $67,521. So let me just pull up my calculator. Right? Because basically, if one generation is 20 years and you have an annual household income of $67,521, so $67,521, right? Times 20. That's $1.35 million. So if you make around $40,000 to $50,000 a year, just as a single person, let's say, and you want to leave one generation of generational wealth, which is the buzzword around here, you need a $1.3 million death benefit. And that's just to cover your income. That's not to cover any other assets. That's to cover 20 years of your income. So if you died last night and you have a child who's 4 years old, you can take care of them till 24. That's what child support says. That's what health insurance says. And I think child support increased that now to 26. Right? But most agents don't know that. Most agents will go, hey, how much is 100,000? Oh, 100,000? Well, let's see. $100,000 term for a 41-year-old. This is the illustration software. This is how you get a quote. So $100,000 term policy for a 41-year-old male. Well, if I tell you the cheapest price is $191 a year, but that's a 10-year term, right? But what happens if you live past 10 years, right? If you get the policy at 41 and you live till 51, at 51, you've paid $1,910. And if you died from 41 to 50, your family got $100,000. But the minute you turn 51, that policy is canceled. Or if you renew it, it's now $1,109 a year. Well, at least for when you're 51, because when you're 52, it's $1,198. Well, at least for when you're 52, because when you're 53, it's $1,304. Well, at least for when you're 54, and obviously I can continue. So the most common sold policy is a 20-year term. So you'll see here someone, again, 41-year-old healthy non-tobacco smoking male for a $100,000 20-year term. Well, it's only $260 a year for 20 years. But the moment he turns 61, it's $2,200 and then $2,500. Right? So the best bet if you're under 50 is to get a 30-year term if you're going to get a term, because it locks you in for the cheapest price for the longest amount of time. And if you'll see here, your premium drops at the age 70 because they can't overcharge you. But then if you turn 71, it's going to cost you $10,000 that year for that same $100,000 policy. So over the course of, let's say you live till 94, which is when the policy would end, you would have paid $874,000 if you got the 30-year term for a $100,000 death benefit, or nearly $1 million for a $100,000 death benefit. Remember, people tell you the premise of buy term, invest the difference, but your investments have to guarantee that you'll have enough money to spend, retire on, and leave someone with assets to bury you. It's not likely because you can't guarantee that with investments. So, from a term policy, let's check a regular whole life. Well, a regular whole life, for $100,000 is $153 a month. Well, wait, that's way expensive. I could pay for a term policy. I could pay $191 a year for the same $100,000 death benefit. Why would I do that? Well, because this one is, what is that, $1,800 a year, but that's for the rest of your life. So when you're 94, it's still only $1,800 a year, whereas the term, it's continuing to get more expensive. Plus, with the whole life, you have this here, which is called cash value. It also pays you a dividend. So a dividend is when the insurance company benefits, they actually pay you some of that portion of benefit. And as you'll see, every year it increases because of your compound interest. It also increases your death benefit slightly. Okay? So now, my PDF isn't loading. What's going on here? Hold on. Okay, there we go. So remember, I said I don't like life insurance that you have to pay for your whole life. So in this scenario, you're paying for it for 10, 20, 30, 40, 50 years. I don't like that. So what if we set something up so that it's a whole life policy, but you're only paying it for 10 years? Well, yeah, it's more expensive. You're going to pay $6,700 a year, but you're only paying that for 10 years. After 10 years, you stop paying for it, just like here in the term, right? You stop paying for it, but in the term, once you stop paying for it, that's done. In this 10 pay, you pay for it for 10 years, but it's still a whole life policy. So the cash value still grows, right? And the death benefit is still there. So now, again, my PDF's not loading. You have my favorite, which is the Index Universal Life Insurance, right? Now this one is $117 a month. Well, it's a little cheaper, but you get a little more benefits. Now, the reason this is cheaper is because you have the flexibility of premium. So you have the ability to overfund this and fund this a little better. So generally here, you'll also see that your death benefit is staying that same 100,000, but you do get a more aggressive cash value. Now here is the same policy in Index Universal, but it's with an increasing death benefit. So this one, actually, when you have your cash value goes into your death benefit. So as you build cash in here, your death benefit grows. Okay? That's just a crash course. I could go a lot deeper into it, but that's just a quick crash course. So again, we see that the average income is $67,000, and we saw here that a generation is about 20 years. So we did the math, and we see that a person who has that 67,000 needs about $1.3 million death benefit. Now we saw that the average income of a single person is about 33,000. So with 33,000, you would basically cut this in half. So you need about $500,000 just for one person, right? And again, that's at $15 an hour, which McDonald's is paying $15 an hour. $15 an hour, 40 hours a week, 52 weeks in a year. That's a $30,000 annual salary. Okay? So again, like Sheed was saying, it's about the structure and the knowledge. The difficulty is that because there's so much information, it might get boring to people. People sometimes are like, oh my God, this is a lot of information. I didn't know it was this much. You know what? It's more than I need to know. I just want something simple. Well, if you want something simple, that's cool, but you're not going to get what you want out of it. You have to have an appointment with someone like myself. Prime example, right? When she was talking about the conversation he and I had, let me see if I can pull one up. Give me 1 second here. Okay. So also when you're talking with an insurance professional, you want to do stuff like this, right? You actually want to have a conversation where we go over your assets and liabilities, right? So this is a client of mine where we went over his assets. He's a self-employed property manager, right? So he has an annual income of about $400,000. He pays himself $150,000, and then the rest goes to the business, right? This is what he has in savings. This is what he has in investments. This is what he has in real estate, and this is his total assets, $1.78 million. But he's also got $500,000 in liabilities, right? But he's also got a $360,000 life insurance policy. Well, if you got $1.7 million in assets, which is physical real estate, if you die and you got $500,000 in mortgage, which this was a policy he took out in the year 2000, which was a 20-year term. It's 2023. He found out he no longer has life insurance. So this is actually $0, not $360,000. But if he had that $360,000 and died in 2019, not 2020 when the policy canceled, this wouldn't have taken, this $360,000 wouldn't have eliminated that debt. This goes back to that mortgage protection life insurance that Sheed was talking about. So again, when you're driving a car with four wheels, you do need a term policy, a 30-year term for, hey, if I die across this next 30 years, the house is completely paid off. This has nothing to do with the fact that I want to leave my wife $50,000 a year for 10 years. So I got a $500,000 policy for that. That has nothing to do with the fact that I want to leave my kids enough money so that if I die, they can pay for my daughter. I can pay for my daughter's wedding. I can pay for my son's first car. And I'm a person who likes to throw a party every year. So I'm going to leave enough money so that every year in my honor, they can throw a party saying, hey, we're celebrating Alonzo. So I'm going to leave $500,000 so every year they can spend $5,000 on a birthday party for me for the next 50 years. Because I'm vain. So you see how life insurance can actually create your legacy? Now, maybe you are spending, you can't spend $3,000 a month. Not everybody can, but you can start small. That's the beauty of life insurance. Different types of policies have different reasons and etc. So again, you're going to have to go through something like this where we're going to go through your assets, your liabilities. We're finding out if you got a will, if you got an attorney, and literally ask you that here. Another question we ask is if you currently have life insurance. Most people, I like to work with people who already have life insurance because it's a lot easier for them to get more. Because then they look at their numbers and they're like, wow, I'm underinsured. This guy was like, nah, I'm good. I already have life insurance. We went over his numbers. I was like, yeah, your life insurance policy was a 20-year term? Yeah, well, it's 2023. When did you get this policy? The year 2000, when my first daughter was born. Okay. How old is your daughter? 23. So guess what? A 20-year term is up. So you don't have any life insurance. And if you did, it wasn't enough to cover this $510,000 liability. Right? This is an actual client, so I'm not showing his name. But he actually didn't mind me showing this. I asked him when I first took this, hey, can I show this to people? He was like, yeah, no problem. Just cover my name. So, this person is completely underprepared, right? He has a bunch of real estate because, real estate is the key to generational wealth. Great. But now if he dies and they physically have that property, it's worth $1.5 million, they have to liquidate that asset. So now what happens with real estate is if they don't have the money to pay the property taxes because he didn't have life insurance, so he didn't leave them money to pay the property taxes, that house gets foreclosed upon anyway, even though he quote unquote owned it free and clear. Now, in his savings, he had $100,000, and in his investments, he had $180,000. Again, maybe that combined with the $360 would be enough to pay that $510,000, and the average funeral is about $21,000. So that takes out that $280 plus the $360 to cover that $510. Maybe they're left with $100,000 in total, but he has two daughters who are college age. What's $100,000 or $50,000 each? $50,000 is not a boatload of money. Plus, they'd have to manage this property because this is a property that he manages. That's how he had the money. So now they have to figure out how to be a property manager. Right? These are gaps that he left. He has no retirement. So I guess he hopes this is going to cash flow him for life, but he also has to physically take care of that property. You also want a complete passive income. So you need some kind of a retirement. He doesn't have that. Right? Now, we didn't go over all his numbers because I have another document here. Right? So I talk to people all the time and they'll say, hey, I can't afford this, that, and the third. And I'm like, okay, well, let's go over this. These are tools that your financial professional should be using with you. Right? I can't afford. Okay, let's go over some numbers. How much is your rent a month or your mortgage? $7,800. That's $93,000 a year. What are you paying taxes? $220 a month. Okay, that's $2,600 a year. What do you pay for homeowners insurance? $130 a month. Okay, that's $1,560 a year. What's your car payment? $444 a month. That's $5,300 a year. What do you pay for car insurance? $75 a month. That's $900 a year. So I literally am able to calculate this stuff for and with you. And that's the importance of actually having an appointment with a licensed financial professional. A lot of insurance agents, again, are going to take you right here and just try and quote you a price, right? I didn't even show you guys all the different ways that I can actually manipulate this. And I'm not looking at the chat. So if you have questions, a sheet, if you want to pop in with questions, feel welcome to. But you know, I just wanted to share a little bit with y'all to show y'all how in depth this stuff could get.
I mean, that's the point. Like I was saying, starting off small, do you get big? There's a lot of people, just at a medium level, they want insurance. Just like he was showing, this guy had the the finance on paper. Let's just say he didn't even own that property, and he passed. And let's just say he had $50,000 in that account. Two daughters, they had a property. They still had to pay mortgage on, and let's say the mortgage was about $4,000 a month. With $50,000 paying mortgage, taking care of their bills, they would probably actually have to move the person out of that house, in order for them to live there and stay afloat. Let's even say that that property, let's say that that
Oh,
property, that one property that they had was getting them about $6,000 a month, but they was paying $4,000. They're only making $2,000 a month off that property, and just like you said, they're property managers now.
mm,
Hot water heater goes out, they got to pay that. The roof is leaking, they got to pay that.
1 second. Real quick, Sweet Thumb. I definitely understand. But asking questions and addressing concerns, so that stuff doesn't come for free, right? So that type of stuff is where either you would come to my brunch and wealths, or you would have a consult. I can't pull the curtains back too far because I can give you all this information and then it becomes pointless. It becomes information overload. Um, like I haven't even began to crack the surface of the information that I'd love to share with you. But all these ideas, you don't want to have too many ideas and confuse yourself. Because this is 15 years of being in this industry, right? It's people make it seem exciting and they're not truly pulling the curtains back. To truly pull the curtains back, I have to sit with you one on one, because that's how I can actually address your concerns. Um, this I can only do, surface level stuff. Like prime example. If I showed you a client that I was mentioning earlier that purchased a $2.4 million policy, this is a guy who has no wife, no kids. Why did he get a $2.4 million policy? How is he using that policy to buy real estate? What is it about borrowing against your policy or borrowing from your policy? Because most people tell you to borrow from your policy, not against your policy, right? So all these types of things. After 15 years, I've learned that's why I do the consults, um, because that's how the conversation moves forward, right? I make it boring kind of intentionally. It's kind of a barrier to entry, right? So, but I'm glad that I caught your attention. But also shoot questions in the chat so I can answer them because
This
I will
this is
answer
like the best
questions.
time. Even
Yeah.
even with you on your panel, you always open up for people to ask questions to where you can give them some information. And this one of the big things about being a, member on your channel. And that's why I dropped the link earlier. I dropped the link again, but the point of reference is when it comes down to it, hey, I was already in the know-how. I sit there, listen to you. You say, hey, you open up for questions. You answered most of my questions I needed, and after that, it was just, hey, pull the trigger. Go ahead and get the ball rolling with me getting the policy. And that's the thing with a lot of people. You know, you'll sit here all day and try to get all the information. Even you have a plethora of videos for people to. You need to go ahead and do a what they call a playlist and just have it structured to people to where, but it kind of dummies the thing down because they do need to just go through the videos and look for the information. But that's on you. I mean, personally, building that playlist will set them up to the point where they can actually do their homework. Because I was the same. That's how I did. For me to sit here and structure, do the homework. That's how I was able to kind of get my point to where I know what I want to do and take the next step. And
Ooh.
prime example with a lot of times people getting policies like you were showing there, like, hey, even though we were talking about the car structure, having all the policies that can benefit you, having the universal, having the you want to come back up with the share screen?
Yeah, I actually,
Okay.
cause I'm gonna pull the curtain back some, but again, even in pulling the curtain back, again, a lot of agents and other financial professionals don't even know a lot of this stuff exists. So it's hard to even go like what I'm gonna show you right now, right? So can you buy a house with can you buy real estate with life insurance, right? With a life insurance policy, right? Life insurance can be used to buy a house. What do I talk about? She collateral assignments. But if you
What are
ask
assignments?
11 agents who are licensed in life insurance, and if you ask 100 agents who are licensed in real estate, can you buy a house with life insurance? They'll say no, because like someone earlier in the chat said, uh, a lot of agents are unknowledgeable about this stuff. Um, no, 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 no. I don't take it as you coming for me, please. It's a challenge. I accept the challenge, right? But like it says, life insurance can be used to buy a house. So you can use your policy as collateral for a mortgage loan. If your policy has cash value, you could also take the money out for your home purchase. These financial strategies aren't just limited to buying a house, right? So,
The crazy
can you
part is
use it?
this.
Yep.
I'm gonna say real quick. So I had a real estate agent I was talking to, and I like to look at things. Same thing with life insurance. So I went to go, get ready to purchase a house, and I was, weighing my options. And one of the things I had presented to the agent was me getting a duplex or a quad.
Mm-hmm.
And the only thing that he knew of was getting a duplex or a quad was getting a I believe it's called a DSRC or something loan
Jumbo
to where
loan.
your debt, yeah, to where your debt to income to where you're getting the property just off the property standing alone. Now,
Mm.
FHA has it to where you can get, 2 to 4 units, up to 4 units, but they have to be within the same building, and you can get that, a duplex, a quad, or a triplex under FHA and still pay the 5% or 3.5 on
Mm-hmm.
that. I had to tell the agent that because he didn't know. He said he never heard of this. And believe it or not, this was an agent that been an agent for 10 years. And I told him, I said, well, I kind of understand because you don't know the finance side of it because all you do is just get in the car, show a house, and ask do you want it or not, and that's it. But
Mm-hmm.
for you to actually take the next step to say, hey, I'm selling houses, I need to know a little bit about the financial side because that's how I can get more clients and get them approved easily and make more money. See, a lot of people only deals, like you said, surface level. As an insurance agent, they're only going to tell you like that small chart height, weight, size. Do you smoke? Not. Okay, I got a policy right here scheduled for you. Versus the person that says, well, how much money do you make? What do you pay your rent? And I can give you different options and variables to actually suit your need versus, one size fit all.
Absolutely. And right here through Google, actually, let's see what this says. What can life insurance not be used for? Let's say it says what kind of death are not covered by life insurance. Oh, well, yeah, if you commit fraud or die under excluded circumstances, such as suicide, within the first 2 years. So that's something called the contestability clause. So if you die within the first 2 years of any life insurance, that's term or whole life, or universal or index universal or variable universal. There is one caveat to that. Guaranteed issue whole life insurance does not have a contestability clause. Guaranteed issue whole life insurance is like Colonial Penn and the commercial see with Alex Trebek. Now, here's the trick with guaranteed issue life insurance, how they get around the contestability clause. So those whole life insurance policies are, number one, extremely overpriced because they don't look at any of your health. Anybody who applies can get it. So they limit you depending on your state between, if it's New York, it's 50 to 75. Most other states is between 45 and 80. Some states is between 40 and 85. But most states is between 40 and 80. You just apply, and as long as you're not HIV positive, you don't have cancer, and you're not on a hospital bed, you got the policy. The max will be maybe $25,000, just the death benefit, and it might cost you at the age of 40 $250 a month for that $25,000 death benefit. But it's either that or nothing. Now, even though those build cash value, they have what's called the graded death benefit. So the way that works is if you die in the first 2 years of those policies, they'll just give your family either in the first year, they'll give your family 100% of what you paid in the policy. So if you paid $100 a month, which is $1,200 a year, and died, they'd give your family $1,200 back. In the second year, they'd give your family $1,500 or 120% of what you paid into the policy back to your family. And then finally, the third year, they'd give the full death benefit. So that's actually something called the contestability clause. That's kind of not what I wanted to see. How can life insurance make you money? So this type of policy accumulates cash value, which can be used as a loan or a source of collateral for a loan. Term life insurance typically covers your life for a specified period of time, usually 1, 5, 10, 15, 20, 25, or 30 years. Most term policies do not build cash value, but still can be used to convert to income because you can convert a life insurance policy, a term life insurance policy, to a permanent life insurance policy. Why millionaires are buying life insurance? Wealthy individuals with a net worth of over $1 million can use life insurance as income replacement in the event of their death, or as an investment vehicle, or as protection against estate taxes. Now, again, I would not say that insurance is an investment. And I sell it. I sell both things. I would not call insurance an investment. I would call it an investment alternative, but I would not call life insurance an investment. How millionaires build wealth using life insurance. With a permanent policy, you pay into two pots, the death benefit and the cash value. The former grows your death benefit with each monthly payment, but the latter, that helps you build wealth. With the cash value aspect, you can grow your wealth each month and build savings over the years. Published January 6, 2023. Let's see. Is life insurance a smart investment? Whether life insurance is a good investment for you depends on your finances, as well as the duration of coverage needs. Term life insurance can make sense if you want to be covered for a set period during which your beneficiaries will receive money to help replace your income if you die. All right. Is life insurance a good way to pass on death? What kind of life? What creates 90% of millionaires? Says real estate. Okay. Where do millionaires keep their money insured? FDIC insurance. Their money is held in their name and not in a custodial private bank. It's because they keep safety deposit boxes. What is better than life insurance? Annuities offer better investment and income benefits while you're alive. Your return is higher because you also aren't paying for life insurance coverage. Instead, all the money is put toward an investment. Annuities also offer more income options like guaranteed income for life. Now, as a person who also sells annuities, that's great. But let me explain to you why, as an insurance agent, I'd much rather you buy an annuity than life insurance, even though life insurance is going to be actually better for you and your family. Number one, life insurance multiplies your money. But here's the thing why I, as a financial professional who sells both insurance and annuities and investments, would prefer you to buy actually an annuity for my pockets. Because with an annuity, all I have to do is have you fill out the paperwork and you have to have the money. The least amount you can put into an annuity is $10,000. Right? So, and usually the average poured into an annuity is $50,000. Right? So on average, people roll over their 401k into an annuity. That's a quick $2,000 check for me. Meanwhile, if you pay $100 a month on your life insurance, that's only a $600 check for me. And I have to wait for them to get your doctor's records, which can take up to 30 days. And I have to wait for you to do a physical exam, blood and urine. And I have to wait for you to sign and. Right? They have to do their underwriting. They take your height, weight, blood, urine, all this other stuff. We take your doctor's notes. We check the MIB, all this other stuff. And if your health isn't good and you don't qualify, I did all that work and I don't get paid. Whereas with an annuity, I get paid. So again, a lot of this is set by the eyes of the salesperson. So, Sweet Thumb, again, that's the type of stuff you're going to get from me is the reality. That's why I charge a fee for coming to sit down with me. Right? See, this is what people will do. How much does a $500,000 life insurance policy cost? It says the average premium for a $500,000 term life insurance policy is $29. Well, and this was published September 29th, 2023. So a $500,000 term life policy for who? Because if you're 60 and you smoke tobacco, the average term life policy for $500,000 is not going to be $29. If you're 15 and you don't smoke tobacco and you have great health, then the average policy will be that price. You want to know? Let's find out how. Right? Let's take a look at different term policies. Because again, you're going to have different, oh, I just made some money. Something just got paid. Cool. I just made some money, y'all. Right? So let's do this. Let's just create a new illustration. We'll go with this guy. Go. And we'll just do a regular illustration. Standard. Go. Alright, we're going to do term. Go. We're going to do 500,000. Monthly.
Yeah, man, because like I say, all it takes. Let me mute this other mic. Can you hear the echo?
No.
All right. So basically, all it takes, man, is you to be on your purpose and actually just doing your study. See, a lot of times people will sit here and get a policy and just get one to be getting one, and they don't know, actually what entails that policy do for them. So it's doing more harm than good. You know, that's like getting car insurance. Just say, man, I got insurance on my car. What's the difference between getting the general and actually getting, what is it, Geico? For one, it's the amount of coverage you get every month. You can have a coverage that pays, in accidents, $50,000 worth of damages, 10,000 for hospital bills. You can have a coverage that pays, up to 100,000 in damages and up to $1.5 million in coverage for hospital visits. You know, and a lot of people they don't know until something actually happens. You know,
Yeah.
that's the same thing with a lot of people. Like I said with me, When my grandmother passed, I didn't know how much she had in her policy, didn't know none of this stuff. She structured everything for her. With me, it's different. I structured everything according to me and for my family. So, if something ever happens to me, my wife and kids are gonna, kind of smile more than kind of say, he was a good dad. It's a little more smiles with saying he was a good dad versus, man, he didn't leave us anything. He talked that talk, but didn't walk the walk. So kind of dealing with that scenario.
I'm just looking at some stuff. So here's a 10-year term for a 41-year-old regular male, right? But remember, they said the average price is $29. So there's different ways that they can quote you to make the price better. So most of the time when you see commercials on TV, they have it quoted preferred plus, right? So they have you quoted like you're healthy like Superman. So I just clicked one button, right? And that one button click now made it $29, right? Same, right? But the only difference is, you see here, right? It says non-tobacco. And here it says, hold on, let me make these the same size. Here it says non-tobacco, right? Here it says preferred plus. Most of the time, agents are just trying to get your money. So they're going to quote you the cheapest, which is preferred plus. This means that you never went to the doctor, you never sneezed, you never had a cold. You're Superman. This is 99.9% of America cannot get this. Right? Unless you're like a firefighter or an athlete. Right? If you're Kobe Bryant, yeah, you could, if you're LeBron James, you could probably get this. Right? But you're not LeBron James. So you're probably going to get standard. So the average price, and mind you, this is only a 10-year term, right? If I were to do this for a 15-year, let's do it for the average. The average is a 20-year term, right? So the average is a 20-year term, and we're just doing this on a 41-year-old. So an average 20-year term for this 41-year-old whose preferred plus is only $41 a month, right? Well, how is it still cheaper than a 10-year term? Now, if I change him from preferred plus back to non-tobacco, which is regular people, right? Just regular people, regular schmegular people who have regular health, will it become $73 a month? The only thing that changed was the health condition. So now let's say he had worse health, right? Let's say he had diabetes. Let's say he smokes tobacco, but he's got great health outside of using cigarettes. Well, his price is $150 a month versus $73 a month, right? Now, let's say he's just a regular smoker, right? He's not LeBron James who smokes cigarettes. He's an average person who smokes cigarettes. For the same $500,000, now it costs almost $200 a month. This is why you can't say, well, how come my cousin Bob, who lives next door to me and is the exact same height and weight as me, pays different? Because he takes different medicines. He was prescribed a different medicine 5 years ago. Because we dig into that. So you also want to read the provisions of the policy. I'm not going to go into that, but there's riders, there's optional benefits, there's all sorts of stuff in policies that needs to be peeled back. Right? So again, like I said, a lot of this stuff right now, I'm just literally going surface level because it gets deep, the rabbit hole. Right? Paying every day. No, insurance is not an expense. It's an asset. So let me show the screen one more time, She. Let's do it like this. So here we go. Also, Google a guy by the name of Ed Slott, if you will, and he'll explain. He's a CPA. He doesn't sell insurance, but he'll also break that down for you. All right. And so here we go. So this document here is what I was talking about. Bank of America National Association. Last updated 8/29/2019. I'm sure there's an updated one further. So these dollar amounts are in thousands. So that means that these are billions of dollars. So I want you to see this here. Number 4, equity investments without readily determinable fair values. Just so we know, what are equity investments without readily determinable fair values? Okay, so under the practicability exception, entities will report these equity investments as cost adjusted for changes in observable price minus impairment. So this can result in carrying an amount of carrying amount of an investment exceeding its cost. So basically, let's see, defining issues. What is the definition? I'm trying to give you. Basically, it's the stock market, is what I was trying to have it show you. But it's not saying what it's not breaking. I guess I didn't ask them the question the right way. But equity investments without readily determinable fair values is basically their investments, and they can't determine what those are because the stock market goes up and down every day. Now, what's this here? It says life insurance assets, not liabilities, not expenses. It says life insurance assets. This is from Bank of America. So it says general account life insurance assets. Now here it says equity investments without readily determinable fair values, which is the stock market. They put $6.14 billion into the stock market. Life insurance assets, they don't say expenses or liability, they say assets. In the general account, they only put $2.9 billion. But in the separate account, they put $19 billion. So in total, they put $21 billion, a little more than 3 times what they put in the stock market, into cash value life insurance. Now, let's look at another bank, Citibank. Last updated 8/2/2019. Equity investments without readily determinable fair values, $5.9 billion. Almost the same in cash value life insurance. Now, Citibank had a little issue because Citibank was Primerica. JP Morgan Chase, National Association, equity investments, $6.1 billion. General life insurance, $6.1 billion. Separate life insurance, $5.3 billion. Right? Remember, I told you guys about BOLI. So let's see. BOLICOLI.com. Right? Let's peel it back. I can give you all this information because, to be honest, I'm the only person who I know who knows this stuff. Right? So let's see. BOLICOLI. Let's give BOLI, bank-owned life insurance. What is bank-owned life insurance? Right? Because that's what we're looking at here is BOLI, bank-owned life insurance. So, bank-owned life insurance is a tax-efficient method that offsets employee benefit costs. The bank purchases and owns an insurance policy on executives' lives and is the beneficiary. Cash surrender values grow tax-deferred, providing the bank with monthly bookable income. And upon the executive's death, tax-free death benefits are paid to the bank. Okay. Now, if we look at COLI, corporate-owned life insurance. Frequently asked questions about COLI, because COLI is something different. What does the company need to purchase COLI? So the company purchases life insurance on a group of employees. The insureds usually represent selected group management or highly compensated employees. The company pays the premiums and owns the cash value of the policies. The company is also the beneficiary of the insurance. The insured employees do not receive any of the insurance benefits directly. So, nor do they pay any of the premiums. Nah, I got insurance from my job. I'm good. It's a benefit. They pay for it. Are you sure about that? So again, with BOLI as we go, Wells Fargo, equity investments, $5.3 billion. General life insurance, $5.3 billion. Separate life insurance, $12.9 billion. Hybrid accounts, 614 million. Right? And that's just the 4 big banks that I have. Right? So there's a lot of layers to be peeled back in this. Let's see. Right? Let's see. What is code? Let's see. Yeah, what is COLI? Right? Since life insurance. Right? So company-owned life insurance or corporate-owned life insurance, again, is a policy that's purchased against the employees. Now, watch this. Again, life insurance is an asset, right? Watch this. Colombian cocaine cartel life insurance, right? I always like to show this, right? Operation Capstone exposed a sophisticated criminal scheme that targeted life insurance companies in the United States and the Isle of Man, where some $80 million of Colombian drug proceeds have been laundered over the past few years. So let's look at the U.S. Department of State, right? So the U.S. Department of State actually shows where a national investigation, these policies were funded with tens of millions of dollars of drug proceeds, right? So what would happen was they would purchase an investment-grade life insurance policy and overfund the policy beyond its face value, which is an effective tactic. So I'm going to go ahead and stop there. I've been going for quite a while. She says, my job pays for it. You already know. She says, I tell people the best time to buy life insurance is when you're alive. So investment companies are insurance companies. So for example, Prudential, Mass Mutual, like my company, the company that I write for, well, my major carrier. So I write for Mass Mutual. I used to write for Mutual of Omaha. I write for Prudential, Emeritus, National Life Group, Lincoln Financial, Nationwide, and quite a few others. I'm a broker, right? So I don't work for a company. I'm also not part of an IMO like Family First Life, People Helping People, World Financial Group, or Primerica. Not speaking down on them, but most of the time, those people are not trained to understand this. They're just taught the buzzwords. Generational wealth, infinite banking, but they don't know how to actually properly manipulate the software to provide you a policy. Right? Like they don't know how to make an IUL a limited pay so that you don't pay for life insurance for your whole life. Buy term, invest the rest. It's a great idea, but I don't think you should buy term. I think you should buy whole life and invest the rest. You just don't pay for whole life for your whole life. Like I showed you guys, you can pay for whole life for 10 years. Yeah, it costs you twice as much initially, but then after 10 years, you wipe your hands, you don't pay for it anymore. It still builds cash value. It's still an asset. And when you die, your family still gets a death benefit. So that's it for me, folks. I'm pretty much done. I'm going to go get me something to eat. Sheed, you got anything more?
Pretty much done too. Hey, I snuck me a little plate in while you was talking, so I'm good.
See, listen, man. I'm spoiled. I'm so used to my wife cooking for me, and my wife right now is in Philadelphia on business.
Yeah.
She's on a business trip, so I
Uh-huh.
gotta go order me some Chinese food or something.
Yeah. My wife, I just got home. She already had the food cooked. Hey, I snuck one in real quick, and hey, that's it for me. Hey, plan your estate. If you're gonna do life insurance, hey, talk to a advisor. Know what you're dealing with. When it come down to it, we talk about generational wealth. $10,000 in life insurance is not generational wealth. $100,000 in life insurance is not generational wealth. You know, you have people that make millions of dollars and they don't even properly structure their life insurance or just in general their finances to live off of if anything was to happen to them. So, hey, lo and behold, hey, you get what you get.
I'm just responding to Sweet Thumb. So another reason, Sweet Thumb, that a lot of people don't pull the curtains back is because dropping information like this puts us in danger of losing our license, right? Because the big rich people in those companies don't like us telling the average person, hey, This is what the rich people are doing. No, 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 sir. Keep that for ourselves. Okay, you know what? We're not going to give you a slap on the wrist. We're going to take away your livelihood and ability to earn an income, right? So they take away your licensure. That's why you'll hear about, you know, the wins, but you don't hear about the curtains being pulled back. But yes, banks are FDIC insured. But only up to 250,000.
Yep.
Right?
You
Life
heard
insurance
about
companies
Usain?
are banks.
Remember what happened to Usain Bolt? They hit him for like 20-something million dollars.
And wasn't that Bank of America?
Mm-hmm.
Yeah.
He added into a company, and the company was, working with them.
Well,
Hey, you had all your money in one bank, and you trusted that one bank. And this lady, one lady herself, is going down for this fraud case. And I'm like, this is conglomerate. You have with people dealing and willing with his money, but she's the only one going down for this, and quite sure she's the scapegoat to where they ran off with 20 million, like call it running off on the plug, with $20 million.
mm-hmm.
Like that's some serious craziness, and
That
he's
is.
only insured for $250,000.
Yeah. So they can guarantee him 250,000, but that's it.
Yep,
Well,
but
it's not hurting the customers. That's the problem. So what happens is really it doesn't hurt the customers, right? So like things like term insurance. Term insurance has a 98% chance that your family won't benefit. So it has a 98% chance that you won't get what you paid for, right? But term insurance is the most commonly purchased type of life. Actually, whole life is the most commonly purchased with 39% of the market share. But term insurance is the second most purchased type of life insurance. And that actually tends to be hurtful for most people because they tell people, hey, get term insurance, it's cheap. And while it is inexpensive, it may not be the best option for most people, but most people are just taught to shop on price, like with car insurance. Like, car insurance, I could go deep into that. I just want to share my screen one more time, Sheed, for one more thing.
all right.
And then I'm going to stop. I promise. So I wanted to show y'all this. So this is actually an article written by a gentleman by the name of Michael Ralph. He's a professor. He's no longer at New York University. He's now at Howard University, and he's a doctor now. So he's Dr. Michael Ralph, not just professor. But this is the relationship between life insurance and slavery. And there's actually some books. Let's see. There's one, a quote from Josiah C. Knott, Life Insurance at the South. And he says, in life and death, in life we're in the midst of death, and a day and hour may paralyze the hand which feeds the helpless. In a country like ours, where with untrammeled energies and eager grasp, we are pressing along the road which leads to fortune and greatness. Sometimes travel too fast, and commercial convulsions are inevitable consequences which bring ruin individuals and the most prudent cautious. Take a person so situated with the uncertainty of life hanging over him. How much cheerfully would he toil on could he say, come what may, my life is insured, and my wife and children are sure of something to save them from want. And this was in 1847. He was talking about get life insurance because I know that you won't have want. He also said, as long as the Negro is sound and worth more than the amount of the insured, self-interest will prompt the owner to preserve the life of the slave. But if the slave becomes unsound, there is little prospect of perfect recovery. The underwriters cannot expect fair play. The insurance money is worth more than the slave, and the latter is regarded rather than in the light of a superannuated horse. Right? So this is Josiah C. Knott, Statistics of Southern Slave Plantation, written in November of 1847. But what I wanted to go over was that Michael Moore documentary, Capitalism, a Love Story, that I told you guys about earlier. So here it says, on August 25th, 2011, NBC and other news outlets reported on a scheme that U.S. presidential candidate Rick Perry, then governor of Texas, had concocted in 2003 to take out life insurance policies on retiring public school teachers through the Swiss firm UBS. Right? Now, the rationale behind his indecent proposal was that these senior citizens had a high statistical probability to die inside of the next decade. And when they did die, the government of Texas would get a profit. Michael Moore examines a similar practice in his 2009 documentary Capitalism: A Love Story through a devastating revelation that a number of Fortune 500 companies, including Bank of America, Citibank, McDonnell Douglas, Hershey, Nestle, Walmart, Procter & Gamble, and American Express have made use of what the industry calls corporate-owned life insurance, or COLI policies, more commonly known as dead peasant insurance. And when Daniel L. Johnson died of cancer, he tells us that Amigi Bank made more than $5 million on policies that it had taken out in his name that were never shared with his dependents. I'm just going to drop the mic right there. Okay.
For that, folks, shout out to everybody that came through. You want to go ahead and give your closing, as you always do, your statement.
You guys
And then
already
I'll
know
get
my
my-
statement. Wipe ass, work in progress every day and see success. And remember, folks, when people challenge you, they don't challenge you to challenge you, but they challenge you to challenge you. Accept the challenge. Salute.
And shout out to people, everybody came through. I hope this was informable. You learned something. You know, like I said, when it come down to it, everybody wants generational wealth. We talk about generational wealth, but do you really know what generational wealth was? And shout out to Broke Farmer. It was sparked by him to have the conversation of leaving some land and some money for his kids. And, you know, him sparking to say, well, the Kennedys already had money. Somebody started off that didn't have money and they built a way to success. You know, that's where the trust started from. The trust started from somebody who didn't have money and wanted money for the next generation, you know. And like always, you know, I say at the end of my videos, shout out, we here and we gone. Peace.